Who's that?
Bill DeLuca.
Hi, Bill. How are you doing this morning?
Fine. How are you?
Good, good. Okay, we are going to get started. We've got about 44 people on the line. We've got Steve's daughter who's going to record this session. Steve's daughter, what's your first name?
Quintina.
Quintina?
Mm-hmm.
Quintina. Okay, she's going to record the session, and we're going to go ahead and get started. And so let me go ahead and load up my my first item here. Hold on just a moment. Okay, and then Mel, I think you're still on the line. Can you see the PowerPoint presentation?
Yes, I can.
Okay, great. All right, and we're going to go ahead and get started. And so, for those of you who are brand new, my name is Jerry Muir, and I'll be conducting this session this morning, which will involve a review of 2 tax returns. So this is our 3rd session. And our objectives today, we're going to review the Tomas Silva return. That's the locksmith that return was sent out last week. We're going to talk about that in the tax layer program and review the schedules A, C, and D. And then we'll discuss the standard deduction, the child and dependent care credit, and the other credits, education, child tax credit, and credit for other dependents. And then we'll review the Franklin and Isabella Harris return that was sent out a few days ago. And so that's our objective for today. And our administration will go for about 50 minutes, take a 10-minute break, go for another 50 minutes, take a 10-minute break, and then we'll conclude by noon today. And with that, does anybody from the St. Killian's leadership team want to say anything? Mel or Art or Fred or anyone else?
I think we're good. We just need to put everyone on notice that Steve is mobile right now. So the daughter is trying to record it for us.
Okay. And is she, it pronounced Quintina. Quintina, are you able to come off mute and let us know if you've been able to start the recording?
It says it is recording. It says the upper.
You can see it in the upper.
Wonderful, wonderful. Okay, real good. And for those of you who do not know me, my name is Jerry Muir, and I've been conducting these sessions for the last couple of weeks. I'm a retired IRS, currently an enroll agent. I've got a practice, and then also retired military. Okay, for those of you who have gone into the Tax Layer Pro program, good for you. I went in yesterday, I went in this morning, and as of this morning, about 6 o'clock, the 2020 tax year software, it's available. And that with the caveat, when you actually prepare a return, what will happen is the 2019 return will display. But again, that's a work in progress. And as of this morning, I could not see any state returns that had been loaded. And so if you're looking for the California return, I didn't see it this morning. I don't know when it's going to be loaded, but I do know the contractor that's working with the government is going to be loading things as the days click by.
And also, Gary,
yeah,
if you print from the e-file menu, is after you go in the screen where they ask you if you want to submit a paper or e-file, and then you save, then the print up there is a 2020 form.
That's correct, and I will be demonstrating that this morning. That is correct.
Okay.
Also, when you jump into the practice lab, there are tutorials, and for those of you who have got some time that want to learn more about it, perhaps maybe you're not completely savvy around a tax return, there's those tutorials. Some of them are pretty good. And then in the practice lab, you've got practice returns, and you also have solutions, school solutions for those returns. Okay, so real quick, if you have your Tomas Silva document in front of you, it's a Word document. We're going to run through the return, and it involves a Schedule A, itemized deductions, a Schedule C, and that's for self-employment, and also a Schedule D for capital gains. And let's see here. Let me go ahead and, for those of you who don't have that document, let me see if I can load that, and that way you have an opportunity to look at it. And let's see, Mel, can you see the Tomas Silva Word document?
Yes, sir.
Okay, great. And so let's see. Okay, and so let me make this larger. Hopefully that's appearing larger on your screen. So we have a single individual. This was inspired. I think I mentioned last week. My strong young son broke my front doorknob, so I had to call a locksmith, and I was very intrigued how quick this guy was. How his name is not Tomas Silva though. How quick he was, how efficient, and just a hard worker, self-employed, and so that's the inspiration. But anywho, so we've got this self-employed locksmith. He lives in Mission Viejo, and he doesn't qualify for the California Renter's Credit because he has his own personal residence. He has income of $50,000, and we mentioned before when you have a self-employed individual, the publication, IRS publication 334, does a pretty good job talking about tracking gross receipts, deductions and credits, and record keeping. And then sometimes, and I'm sure you've bumped into this if you've done returns for a couple years, sometimes you'll meet people who are highly organized, they have QuickBooks or some other type of method to account for all of the gross receipts, all of the income they have. And other times you've got people, when you ask them, hey, how much do you have in gross receipts? They kind of look at you and say, well, I don't know. And so there are methods to report or record income. And they could be as sophisticated as QuickBooks. They could also be as sophisticated as every dollar the person receives, whether it's cash or currency, they put it in the bank. Or in some cases, people just write it down on a scratchy piece of paper. But it is their obligation because I don't know if we have the IRS agent on the line this morning, but when I used to audit for the IRS, I will tell you that IRS auditors, they're highly trained and they spend a lot of time with income. A lot of practitioners want them to go right to expenses, but no, if you know anything about the IRS and anything about an auditor, they will spend time with income. So it's probably a good thing to mention the publication 334 to your taxpayer. In this example, the taxpayer made estimated tax payments, and yes, there's only 3. Generally, you're going to see 4, but this is what we have. We talked about the concept of material participation, and I cited the temporary treasury regulation, but for our purposes, if you're in a business and you're working it, you're running it, that day-to-day activity, you materially participate. If you don't, that's outside the scope of VITA, and we don't address that. Your business codes, there's a laundry list, and sometimes people spend a lot of time with that. So you pick the code that's close enough for the particular type of activity, and that's the one that I found. And we'll show you in the software. Your expenses on this particular taxpayer include supplies, tools, work clothes, business liability insurance. I was talking to the guy who fixed my lock, and he says, yeah, he has to have it because obviously they got to be bonded and they have to have some type of insurance. Business license, he had to have a business license, and a lot of self-employed individuals in the state of California in their chosen endeavor, they have to have a business license. Not all of them, but a lot of them. And then that DMV fee for the truck, he does have a truck. He also has a sedan. That DMV fee, in addition to the mileage, is allowed on the Schedule C as in Charlie. And then we talked about the cell phone. He's got one phone and one phone only, so he's not going to get that cell phone expense. We'll demonstrate that. And then bank fees. Sometimes banks will, I think my business account, I think they charge me like $14 a month, something like that. So that's pretty typical. And then here's the information pertaining to his business vehicle and the number of miles driven for business. And when you ask them about business miles driven, sometimes, again, they'll give you that look and they'll say, I don't know. And so it's up to you. I'm not sure how you're going to handle it at the St. Killian site. What I do at my site is we do some reconstruction if we have time. And then we explain the concept that you've got to maintain some type of record keeping for your business miles. And it can be sophisticated or it can be unsophisticated, but you got to document that. Okay, and then this taxpayer also had a little bit of income as far as interest and dividends, and we'll show you that. And then he also had a Schedule A as an alpha. He had a personal residence. He had a loan. He's got some property tax he's got to pay. He's got that sedan, so he pays the DMV fee, and that's deductible. And then he donated money to a charity and drove for the charity. And then he also has some capital gains. And I think I mentioned this once before. I was sitting at a VITA site a couple of years ago, and we had a taxpayer who had all of his income was long-term capital gains. And I'm sitting there with a certified public accountant who's practiced for about 20 years, and we're scratching our heads trying to figure out why this individual has little to no tax on his income. And then, of course, the light bulb went off, says, oh, but of course, it's long-term. And in his particular case, he was paying well less than 10% on his capital gains as far as tax. And then I'm going to get some involvement here if I can call in someone. And how about Natalie? Is it pronounced Conklin?
Yes.
Natalie, great. Natalie, let me ask you, are you familiar with the use tax in California? I can barely hear you, Natalie.
Okay. Can you hear me now?
I can hear you now.
Okay, great. I know that I can share that if you make purchases out of state, then if you didn't pay a sales use tax at the time of the purchase, then you need to report that use tax on your California return.
Yeah, that's basically it. So I'll give you an example. Let's say you purchase a recreational vehicle in the state of Montana and you pay $200,000 for it. And then you're a California resident, you drive it back to California. And let's say the tax in Montana, let's call that 4%. And so 4% of 200,000 is $8,000. You get back to California, you register the RV with the California authorities, and they say, hey, in your jurisdiction, your sales tax is 9%. So 9% of 200,000, if my math is right, is 18,000. And so you've paid 8 to the Montana authorities, and the California authorities, they want 18, but they'll give you a credit of 8. So you're out of pocket in California another $10,000. So that would be that use tax. Now, of course, there are certain exceptions, like if you buy a donut in Montana and you don't pay any sales tax, let's say there's no sales tax in this example, and you fly back to Los Angeles, and of course, if you bought a donut in LA, you're going to pay 9 or 10%. That's a perishable item. You're not going to be charged the use tax on the donut that you bought in Montana. But again, the automobile example is probably the best one. And you got to ask the question in the software. When we do this year after year, you have to ask the question. And sometimes people will look at you and they'll say, what's a use tax? And so you just explain what use tax is. Okay, and then also Tomas, he doesn't have health insurance through his self-employment, his father, because Tomas is a young guy and Tomas's father has health insurance for him. Okay, so there's our scenario. Let's go ahead and see if I can jump into the software and we can go ahead and go through the software here. Okay, and again, hopefully most of you had an opportunity to register, but you do want to. If you haven't registered, what you can do is you can talk to the leadership team at the church, the VITA leadership team, or if you're completely stuck after this presentation, you can call me or text me, and I'll try to get back to you today or tomorrow, kind of navigate setting up your practice lab. And if you're brand new or you're mostly new, you do have to register for the practice lab, and you also have to register for the certifications. So here's the practice lab, and as I mentioned, if you cursor down, you're going to see those tutorials, and those tutorials start, for our purposes, in section 4 on your left-hand side, preparing a return. And I've checked out a couple of them. I've actually checked out all of them in years past, and I think they're a little bit better than the previous years. As I mentioned before, there was a presenter a few years ago who was very knowledgeable but spoke at a rapid fire delivery, and so it was kind of difficult to follow these. But they've gotten better. She's I think it's the same person. I think she slowed down her rate of delivery. Okay, so we're here at the practice lab. We go to the practice area, and you can see where it says 2010, I stand corrected, 2020 tax program. if you're at the VITA site and you've got someone who comes in with a previous year and your site does prepare previous years, and sites are like people, every site's going to be different. At my site, we do amended returns, we do 2019, 2020, we'll do all sorts of stuff, but other sites may not. You got to check with your site coordinator. But anyway, if you click change tax year, then you will toggle to the 2019 tax year, and you can see the 2019 tax program, and then you can prepare returns. So let's go back to our 2020. And let's go to the Tomas Solar return. Okay, we're going to go through step by step, and then what I'll do is I'll ask if anybody has any questions, and I'll try to answer those questions. And so we start off with filing status. Generally, this is not an issue at the VITA site. However, sometimes you will have people who want to claim head of household, but they don't meet all the requirements. And so what you should do, this is what I do. I have a 4012 with me, and then when I'm presented with a fact pattern, I go to the 4012, and typically it's easy to go through, but you want to use that decision tree. You want to get that filing status correct. And then, as I mentioned before, and I'm speaking for VITA, I don't know about AERP, so if someone from AERP can chime in, that's great. But for VITA, we don't prepare married filing separate returns. In California, we just don't do that. What about AERP? Is that the same thing for AERP?
Yeah, at least Southern California. Northern California, I think, does, but we don't down here.
Okay. And then, as I said before, when something's out of scope for your site or the program, you should invoke what Nancy Reagan used to say. Just say no. You can be polite about it and use care bear language, but you just tell the taxpayer, we're not trained to do that. We can't do that for you. And your options include going out in town and finding a paid practitioner. And that's the way I do it. And when they say, well, who's out there? And say, well, you got a computer, you can Google it. There are thousands of practitioners, but you can go out and find one. But anyway, this guy is a single individual. And then we got that personal information, and this is easy breezy stuff. As far as the name, you want to make sure the name is the name that is reflected on the Social Security card, because what happens is if you get the name, a nickname, and it doesn't match a Social Security system, what will happen is the return will reject. And that's a big thing with the electronic return originators. They'll submit a return and it comes back rejected because of the name. So you want to make sure you get that correct. And then here, we've talked about this before, where it says taxpayer can be claimed as dependent. It starts there and it goes all the way down to virtual stuff. If it applies, you're going to go ahead and check it. Typically, the ones that you're going to see at the VITA site would be the taxpayer can be claimed as a dependent. This would be perhaps maybe a young adult who's working, lives with mom and dad can still claim them. But this young adult still wants to file a return. Maybe they don't have a filing requirement, but they want to get a refund. And then sometimes, and I've seen this more often at the VITA site, I've seen taxpayers who are considered blind by the definition of the IRS. And we're actually going to talk about that definition today. And then I have seen a lot of mothers come in and brothers and sisters come in for their loved ones who've passed away, and they're filing that final return. And then, of course, the Presidential Election Campaign Fund. Used to be people get all excited about that for whatever reason. You just tell them, hey, do you want to contribute? It doesn't affect your return. You're essentially issuing an order to the federal government to separate funds and put it in that fund. And then what happens is when a candidate qualifies, and that's the big word, they got to qualify, then they can go ahead and get matching funds or funds from the federal government. But you do not want to engage in a political discussion that will not go good for you or the other individual. You just want to stay away from that. Next, address, and I mentioned this before, there's a statute or a code section that says you are required to keep the IRS informed of your mailing address. A lot of people do, some people they just don't. And then what happens is they end up getting money collected from their paycheck and they're stunned. They go, why are you collecting money? And the IRS revenue officer says, well, you were issued a statutory notice of deficiency. It defaulted. We tried to get a hold of you, couldn't find you. And now we have found you. We're taking money out of your paycheck. So the bottom line is you want to tell your clients, your customers, your friends, and your enemies, make sure the IRS knows your current address. And then phone numbers, and I think I mentioned this before, the IRS will not call you out of the blue and say, dear taxpayer, go ahead and put $5,000 in your iTunes card because you owe us money. What happens is that initial contact is typically through mail, snail mail. And then of course, once the relationship has been established with the revenue officer, the revenue agent, or one of the IRS employees, then sure, they'll call you and they'll identify themselves. They're not demanding money. If they're a revenue officer, they'll explain that you owe money and there's ways to pay it, but they're not going to have you put it on an iTunes card or meet you down at the city park with a sack of currency. Those are fraudsters. They're all over the place. And unfortunately, they prey on low and moderate income taxpayers who have English as a second language. It's really sad. But again, I try to educate people as best I can. The IRS, they have a way of collecting money, and they utilize due process, and they keep people informed, and they tell them where their office is and who their boss is. Okay, we have no dependents, and we also talked about that identity protection, PIN, a couple weeks ago. And this is something you may see at the site. The taxpayer will bring a letter in, and then you can electronically file if you've got an IPPIN. Okay, we don't have any W-2 information, so we're going to go straight away to the Schedule C as in Charlie, and that's the profit or loss. And I did hear something a couple days ago, and if someone's gone through the training, if you can go ahead and validate this, I did hear on the Schedule C in the VITA program, they're allowing now up to $35,000 of expenses, and that's a change. It used to be $25,000. Has anybody heard that?
Well, I've read that.
All right, very good then. So 35,000 it is. All right, we're going to open up this Schedule C, basic information. Sometimes, like my locksmith, I asked him, hey, what's your business? He goes, I don't have a business name. My name is whatever it was, Fred Flintstone. I said, you have a business card? He goes, no. So in this particular case, if he doesn't have a business name, we're going to leave that blank. Now, of course, you can have a business name, and that's great. Then you'll enter that. And then typically in the VITA program, I do not see taxpayers who have an employer identification number because we don't deal with taxpayers who have employees. So typically you're not going to see that. Here's the business code, the list of business codes. So you click on there. I'm not going to do it. You can do it on your own time. And you'll find an occupation that is spot on or close to what your self-employed individual is involved in. And if you get that wrong, I don't think the return's going to reject, and I don't think the IRS is going to chase you down and do anything to you. But you want to do the best you can, because what happens is, and I've seen this before in the IRS programs, they collect that data and they use it for various purposes. Okay, so we're in the income section. And again, if you've been doing tax returns for a number of years, this is usually not a big deal for you. But when you're dealing with a new self-employed individual or someone who does not have the best record keeping, this is where you probably want to spend a little bit of time and explain to them it's their responsibility to report what they receive. And I have, at our site, I work at the Coastline site, and I've seen a lot of taxpayers who will tell me, Jerry, I've received $4,000 in gross receipts, and I've got $25,000 in expenses. And I tell them, okay, then how do you live? And usually the response is, it's not easy. And I tell them, well, no, this is a mathematical problem, because if you have no source of income other than your gross receipts of $4,000 and you have $25,000 of expenses and your bank account has a modest amount at $500 or $600, then mathematically it's not possible. And so I engage the taxpayer in a discussion, and generally what they'll say is that, yeah, you're right, maybe it was more than $4,000. So again, you want to have that discussion. I think it's important. So anyway, you'll enter that data in here. And sometimes you might have other income, but typically that's the line you're going to have. Okay, so we've entered that. And then in the VITA program, we don't do cost of goods sold, but we do general expenses. And in this case, this particular taxpayer had the expenses for his business liability insurance. And then he also had supplies. And then if you remember from the scenario, he had a business license for $100, and he also had the DMV tax on his business truck that he uses full time for the business. So that totals $400.
Is he on drugs?
Is he on drugs? What do you mean?
Is he on drugs?
What do you mean by that? Okay. I guess maybe that was a joke. Okay. Okay, so we got our general expenses, and now we have an automobile. And in this particular case, he drives a Chevy S10, placed it in service on that particular date. And then down here, we've indicated the amount of business miles. And business miles are simply, you're driving your vehicle to visit your clients, you're engaged in some type of business activity. He doesn't commute because he doesn't have a W-2 job. And he has other miles where he's driving to maybe the laundromat, visit friends, relatives, go shopping, things like that. And then down here where it says, is the vehicle, does he have another vehicle? Yes, he did. He has a sedan, and the vehicle's available off-duty. And evidence. You know, I'm not an expert, but I've done VITA for about 30 years. And I have never seen a taxpayer who did not have some type of evidence regarding their personal or business automobile. They had a DMV bill, they had gas bills, oil bills, repair bills, automobile insurance, they had something. And so I usually check that. In fact, I think I've always checked it. They do have evidence to support the deduction. And the evidence is written, and I know in this world we have stuff on pieces of paper. We also have stuff that's written in electronic format, so that means it's written. So I do the old check mark, and then we're good to go. And you will see that this 18,000 business miles is going to generate quite an expense for the taxpayer.
Excuse me.
I stand corrected, quite a deduction, a very generous deduction. And also, sometimes you might have a taxpayer who says, well, I want to take the actual mile method or actual expense method. And you just tell them, we don't do the actual expense method in VITA. And again, if they're adamant about it, you can say, well, then your next option is you can go out in town and you can find a paid practitioner that will help you out. Okay, I'm going to stop for a second. And do you have any questions or comments?
Is the entire DMV amount deductible? I thought only a portion of the DMV expense was deductible.
The question is the entire DMV amount deductible? The answer is when you look at the DMV bill, there's an amount that says this could be your tax deduction.
Yeah.
And for this particular taxpayer, since he has two vehicles and he used one vehicle completely for business, 100% for business, then his DMV bill for that portion that says tax deductible will be on the Schedule C.
Thank you.
And that's a good point. If you have a person who has a vehicle and they got one vehicle and they're using it for business and they're using it obviously for personal, then you're going to have to allocate between the Schedule A and the Schedule C for that DMV bill.
I have a question. My name is Julie, and I have a question on the mileage. I've tried to figure out, it's very confusing to me. If you have your own business, you can count the miles that you drive from your house to the first locksmith duty you have, or not?
The answer to that question is yes. Now, if this particular locksmith, let's say he's got his house and he has he's got a little bitty locksmith building where he keeps his tools and he does his billing, then going from his residence to his place of work, the locksmith shop, is considered commuting miles.
But if he just goes from his house to his first job, that's business not miles. Commuting.
Correct. That's business miles. Correct.
Okay. Thank you.
And then commuting miles, and I think I mentioned this before, I knew this guy. He commuted from Los Angeles, California to Frankfurt, Germany to go to work. And I don't know how many miles it is, but that's a lot of miles. And so that would be all commuting miles for him. Now, of course, in his particular case, he flew and he was an airline pilot. So he always was able to get a free ticket from Los Angeles to Frankfurt. But if he had to pay for his own ticket to go from LA to Frankfurt, that would be commuting, which is non-deductible. Okay. Anything
Jerry,
else?
follow-up question on the registration. Most of the times, the taxpayer will give us how much they paid for their registration. Mm-hmm. So I'm always under the impression that whatever total you pay, only part of it is deductible. Is that correct?
The answer is yes, a large portion of it. And so what I do is I ask them for their DMV bill, because when you look at your DMV bill, there's other things that you're paying that are not deductible. And I don't know what the exact percentage is, but I ask them for the DMV bill.
Yeah, got it.
But Jerry, you just said that for the business, the whole amount is deductible.
What I said is when you look at the DMV bill, there's going to be an indicator that says this amount may be tax deductible. There are other items that are not. And so again, I don't know if it's 80% or 85%, but you're going to have to look at the DMV bill.
On the DMV bill, the deductible part is the part, the number to the right of the letter L.
Yeah.
Very good.
But if they have a separate car that they only use for business, then the whole DMV bill is deductible. Isn't that correct?
No, I think if you get into...
Because that's a business expense.
Yeah, but I think if you get into the Internal Revenue Code, there's a bunch of things. And what I'll do is I'll definitely look up all the rules on that. Not right now, and we'll share that with you later. But for our purposes, it's going to be that amount that I forget who said the L amount.
That was
okay.
Scott.
So that's not the amount that in the practice question, because $245 is a lot. And that's why I had a problem trying to figure out what to put in there when I did the practice return.
No, the comment about the L is for
this. Let me ask you this. You said $245. What return are you referring to?
Well, whatever the one we're talking about right now, whatever he paid.
Okay. Yeah, and it said, let me look it up. I think it said a total of $300. Okay, and so, and that was going to be the amount, that L amount that we talked about. Okay, we're going to march on. Here we go. Okay, so we've got our vehicle. We've entered that data.
200.
And then what else do we have to add for the Schedule C? Someone say other expenses.
Other expenses.
Other expenses. Let's look at that. And then this is something when you're or looks like we're getting some feedback. You're going to see a lot of different expenses. And when people ask me, Jerry, can I deduct this? I always tell them, is it ordinary? Is it necessary? Is it reasonable? And is there a business purpose? And if it meets all four of those tests, then the answer is yes. So in this example, we've got tools, work clothes, and bank fees. Those are all reasonable, necessary, ordinary, and has a business purpose. And I think in the VITA program, you're going to see some unusual things. And so what I always do, I have that discussion. Like I say, I used to be an IRS revenue agent. And one thing that we were taught is ask a whole bunch of questions. And usually you're going to get the answer if they're going to be candid with you. But with the clients, you're trying to help them out. So you just ask them, tell me about your expenses. Sometimes that open-ended question will help you out. Let me ask, what's somebody come off mute and tell me one of the most unusual business expenses you've seen on a Schedule C?
Supplies, maybe?
Yeah, I guess, the type of supplies. But yeah, you're just going to see all sorts of things because people in business, they buy all sorts of stuff. They incur all sorts of expenses. And then, of course, this is something I think you see in the material, the form 6744. you have a lot of people, like I've gotten traffic tickets and I've gotten parking tickets before. You cannot deduct your business, you cannot deduct your traffic tickets and your parking tickets on your Schedule C. And some people say, well, gee whiz, I was trying to deliver something for a client. I parked the vehicle for a couple minutes. I dropped off the stuff with the client. It was all business related. The answer is you can't deduct it on your Schedule C. You can't deduct fines. You can't deduct bribes on the Schedule C.
Well, this isn't unusual, but sometimes you get people who try to write off every time they ate lunch at work.
Yeah, and for our purposes, now, if you jump into the regulations, you jump into, I think it's the publication 465, there's a time and a place for deducting meals, but typically a guy or a gal driving around, delivering stuff, working locally, they're not going to be able to deduct their In-N-Out hamburger on their tax return. That's not going to happen.
Is there a limit on the amount you can deduct for tools?
Well, you know, the short answer, that reasonable thing kicks in. And so, like, I'll give you an example. My locksmith, I said, hey, tell me about the tools you have. He goes, well, he opened up his bag. It was the size of a small suitcase. He goes, this is my life. I have these tools, because he had a narrow practice. There are different types of locks and all that. He goes, this is what I have in this bag. And I said, all right, well, how much did those tools cost you? He goes, these tools cost me about, $550. Okay, so if he had a locksmith who's generating revenues of $50,000, and he purchased $100,000 in tools, and he was only working on front doors and residential units, then I would say, okay, we need to have that discussion. What's reasonable? Why do you need $100,000 in tools? And that's probably, in fact, I would think that would be definitely unreasonable. But again, that's when you have that discussion. Tell me about your business. Tell me what you use in your business. And why would you have $100,000 of tools? I don't understand. Explain to me. So the short answer is, yeah, you want to make sure it's reasonable. The other example I gave, I think last week, is I had a real estate agent. She was closing these small deals. There were $200 or $300 a piece. And then she would have a lavish meal with her clients and her husband to the tune of about $500 each every time she closed a deal. And I was an IRS agent at the time. I said, you know something? That is unreasonable. So we're going to have to come up with a number that's reasonable, have that discussion, but it's certainly not $500 every time you generate a $300 fee. Doesn't make sense. Hopefully that answers your question.
You know, Jerry, I had a taxpayer once who wanted to deduct his charitable contributions.
You mean on the Schedule C?
Yes.
Yeah, and if I remember correctly, and I don't have this in my brain, I think, and I'm only talking about a Form 1040, I recognize the corporate return is different, but on the 1040, in 2020, there's only two places that I can think of, the Schedule A, and then that $300 deduction that's new this year. Okay, we're going to move on. So we've done all the expenses. The qualified business income deduction, I'm not going to touch that tab. It's going to auto-generate, and that's at 20% of net income, which is a good thing for him. And then I think we talked about the business use of the home. That is outside of the scope of VITA as far as I know. Okay, and let's see. So we're done with the Schedule C as in Charlie. And this, I think this is new. I think either last year, last year, where it's big, bold font, where it shows you, the practitioner, or you, the preparer, net income. And of course, we know net income is going to be subject to self-employment tax. Okay, what else do we have? We took care of the Schedule C. Now let's go ahead and take care of that Schedule A as an alpha. And so we're going to go over here to deductions. And this particular taxpayer, Mr. Silva, he had a loan on his primary residence. And typically what will happen is they'll come to the VITA site with a 1098, that's an information return. I've seen it a couple times where they have a private loan. I mean, if somebody wants to lend you money and they're a private individual, yeah, you can borrow money if they're going to loan you money. But typically what's going to happen is they're going to evidence it in a promissory note. They'll have an amortization schedule. And then, of course, if you don't pay the loan back, then that individual then has recourse in a court to make sure they do get paid. Okay, so the 1098 in this example showed $9,000.
Where's my $9,000?
And we talked about points. Again, if someone pays points, that means fees for the loan. They have two options. Option one, they can deduct it in full, or option two, they can amortize. And if they amortize, then that'll be carried forward the entire length of the loan. Most home loans are 30 years, but as I've mentioned before, I had a home loan that was 1 year. I had another home loan that was 22 years. So it depends on what you can negotiate with the bank. Okay, so we're done with the Schedule A interest. And then down here, real estate taxes. And if you look at your real estate tax bill from, if you're in Orange County, I think they send it to you once or twice a year. And so you're going to see the amount that you can deduct for real estate taxes. And that, again, that's right off the real estate bill. If a person doesn't have it, doesn't remember, I do know they can go into the Orange County assessors, electronically that is, put in some information, and then the amount will be shown. Does anybody have any recommendations or feedback regarding real estate taxes? Okay.
Doesn't happen much with us, but there is a limit on the tax that's deductible based upon the value of the home, and it's different from the feds in California.
Okay. Yeah. Yeah. But again, I think for our purposes here in Southern California, Orange County, and Mission Viejo, St. Killian's, typically they're gonna have that bill, or they'll be writing a check, and so that'll be that.
If I can make a comment regarding real estate taxes,
Okay.
When you look at the real estate invoice or bill or statement that you receive, you need to make sure that that you include the real estate property taxes that were paid in that tax year versus, prior year or future years.
Yeah, and generally there are certain exceptions, but generally, since you're looking at the 2020 tax year, what happened, kind of like what happened in Vegas stays in Vegas, what happens in 2020 stays in 2020. That's the general rule. So, okay, let's go ahead and march on. I think we're done with our interest, and our next item that we have is we got our DMV for that sedan, and there's our personal property taxes. And I don't know, because I don't have toys. I just have a couple cars. I think, someone correct me if they're wrong, I think there's a tax, a yearly tax on personal watercraft. Is that correct?
Yes, that is correct.
Okay. And there's probably
excuse me. I'm not sure if it's yearly.
Yes, it's yearly.
Okay, good. Thank you.
For the county the boat is in, which is
the boat
on
tax,
your
okay.
property or whatever.
And so that would be
Thank
personal property, because everything that I've learned in my accounting experience, you have different types of property. You have tangible personal property. You have real property, which includes land and items that are affixed to the land, like buildings, and then you have intellectual property. So tangible personal property, car, boat, ski-doo, something like that. All right, so we're done with taxes, and we're going to hit continue, and then we're going to go to the section that deals with charitable issues. Bless you. Okay, we talked about this last week, and typically this is not an issue, but sometimes people say, Jerry, I gave money to this particular entity. And I say, okay, well, let's find out if that particular entity is a charitable or qualified charitable organization. And typically there'll be a tax ID number. That charity, then they're collecting money. They file their own Form 990, and that's usually not an issue, but we have run into it at a VITA site where a lady, and I think I told the story, she had $8,000 she gave to an entity. And I said, you know something, I've never heard of this entity. So we looked it up. Nope, it wasn't a qualified charitable organization. I said, hey, you're a nice person for giving money to this entity, but you can't deduct it on your federal tax return. But generally, that's not an issue. Most people donate to a qualified charitable organization. Okay, so this guy, he donates to this qualified charitable organization. We put in the name. In this case, it's cash. And donation, if you're donating throughout the year for this offer, this is how I do it. I simply split the year. But in this case, we had a date where he donated the cash. And that would be cash, currency, something like that. If you're donating cans of green beans, and you're donating shoes, and you're donating coffee cups, it doesn't go here. This is for cash. Okay, we're done there. And if you're donating what are called non-cash gifts, then down here where it says non-cash, less than or equal to 500. And of course, this would be a little bit of discussion, because if someone comes to the VITA site and says, Jerry, I donated an old pair of tennis shoes to Goodwill. I would say, okay, well, then what's the value? Well, the value is $100. Well, you probably want to have a discussion. I don't know if it's $100. I'd probably look into some material, have that discussion. If they're donating an entire wardrobe of used clothing, again, it's probably that discussion, because you probably want to have the discussion then, as opposed to if you're in front of an IRS auditor, the auditor is going to go through the laundry list. And I've done this before as an auditor, and I would make large adjustments because people would claim essentially the fair market value when it was new. And you can't do that for used items. That's not going to work. But anyway, have that discussion. Charitable miles, you are driving your vehicle and you are working typically as a volunteer, and you're not being reimbursed for your charitable organization. So like I used to visit the hospital up at Long Beach for the veterans. We'd go down to Camp Pendleton and work with the veterans and the active duty folks for a charitable organization, and those are all charitable miles. Okay, get that. And then you're not going to see more than 500. I believe that's out of scope. And then when you talk about donating real property, that would be land or something affixed to the land or both. We don't do that in VITA. You have to get an appraisal. And if you don't, there's a court case out there where you're going to lose the deduction. So that's something you tell them can't help you at this site. You got to go out in town, and your preparer is going to ask you a bunch of questions, and they're going to ask you, do you have an appraisal from a certified appraiser?
Hey, Jerry,
okay.
Question.
Any questions about gifts to charities?
Jerry, I got a question. Can you do the $500 on the Schedule A and then the additional $300 above the line deduction that's special for this year?
The answer would be no, because that above the line, that $300, that's for people who do not itemize.
Okay, perfect.
Okay.
Jerry, where would you enter the $300 above the line charity?
You will not see it in this software because it has not yet been populated. And so the answer to your question is, I don't know, but I'm sure when it's posted, there'll be some type of tab that says above the line charitable deduction.
I was hoping if you just put in the cash contribution, and then when it decides whether to itemize or not, it would take 300 of that and move that above the line. Hopefully.
Well, we could try that. We won't try that here. That's going to be a little bit involved, but yeah, we can try that later and see if that works. Okay, moving on. Okay, so I think were we done with the Schedule A? Let's go back to our Tomas Silva and let's see what else he had. Yep, we're done. Okay, now we're going to go to our capital gains. And I'm sure some of you out there have probably had some really long returns, and it's up to your site coordinator. When I have taxpayers come to the site and they have many, many transactions, like hundreds of transactions, then there's a couple ways to handle it. You can aggregate it, but I do not have my preparers sit there for 6 hours and enter 100 transactions. We're just not going to do it because there's a time factor. We just don't do it. Was there a question out there?
Did we cover the cell phone expense?
Yeah, we talked about it last week, but the short answer, when you have a cell phone, like for example, I don't know if you can see my cell phone. So I have a cell phone. This is the only phone that I own in my entire life. I don't even know what a landline is anymore. They took that out years ago. And I use this I teach college accounting and some tax classes. So I take calls from my students. I also have a tax practice. I take calls from my clients and I call my clients. And then I also use this, I have to call my wife once in a while. And I call my sisters and my brothers and my friends. And then I call for all sorts of stuff. So the bottom line is, even though I use this for business, a portion for business, I can't allocate because I have a flat fee. And this is inherently a personal item, kind of like the internet. So this is something you cannot deduct if you have one telephone.
Hey, Jerry, is it possible on VITA, they're not allowing us to prorate that because we're only doing cash accounting and not accrual accounting?
No, what it is, and I don't have the regulation with me, but that particular item, like I say, that cell phone, if you got one cell phone, and for lack of a better term, it's inherently a personal thing, because everybody, like I used to tell actors and actresses that I audited in Hollywood, they would say, Jerry, I'm all about business. I'm 100% business. I'm saying, no, you're not. Because everybody, whether you're the president of the United States or you're the Pope or you're a CEO, everybody has a personal life. And so that means that personal life, you're using your cell phone in your personal life. So the bottom line is it's not deductible. And when I work with the clients at the VITA side, I tell them, I got it. You're using it mostly for business, but it's inherently a personal item. You can't deduct it. Okay, moving on. For your capital gains and losses, we had a discussion last week. We defined what a capital asset is. For our purpose, basically, folks are going to come to the VITA site and they're going to have perhaps maybe shares that they've sold, mutual fund shares or shares in a company. They may have some bonds, but typically that's what you're going to see. And then I've seen people who come in with these brokerage statements, and I'm not the smartest guy in the world, but I've got some advanced degrees. I've been in the tax world for 30 years, and I've looked at a bunch of brokerage statements. And sometimes I get a brokerage statement, I scratch my head and say, what corporation is this? And I have to ask a whole bunch of questions. I'm looking at pages, and finally we figure it out. Sometimes that may happen, but typically you get that 1099-B as in Bravo, and that will usually answer the question. But I'm not afraid. When people look at me and say, you should know this, I tell them, you know something, I don't know this. You're here, you receive the income, you got the shares. Why don't we have a discussion so you explain it to me so I can help you out, because I don't know everything, and neither do you. So anyway, just having that friendly Care Bear conversation, typically people would give you the information. So anyway, back to our taxpayer. He sold some shares of Gargantuan Electronics, and he owned these shares for over a year. And that means long-term. You don't have to worry about that. You just plug it into the computer. So you defined the shares. And when you sold it in June 15, 2020, sales price is $2,900. And typically you're going to see this cost basis. If the cost basis is not reported to the IRS, and you got the drop-down menu, and then you'll go from there. And I have helped out many a taxpayer who did not have the cost basis reported to the IRS. And so typically we would do that research and find the cost of shares going back 30 or 40 years. I think I helped out one guy one time who bought something in the late 50s. And it took a while, but we were able to determine the cost basis because he couldn't remember what he paid for it. Okay, and then the cost is $2,400. So you can see right there, the difference is going to be a $500 long-term capital gain. And I know we probably see a lot of this at the VITA site. Does anybody want to share a short story about their experience with someone who had capital gains?
Yes, this is Hal Matson from AARP Tax Aid.
Yes,
we
Hal.
had a 85-year-old woman that came in, and she had some of these issues with 30-year-old stocks. She had done so much research. She found, followed companies that were resold, that merged, and she only had one item on her list. And so we took the time. She spent so much time doing this research. We took the time to research the one issue she had, and we resolved it and did her taxes. Normally we wouldn't do that, but when somebody puts in that much effort, you feel obligated, especially when they're an elderly person with many, many years of capital gains that go back 30, 40 years.
Oh, I have a reverse story to that. Taxpayer comes in, 7,000 capital gain, don't know the cost basis, and said, just use 0. I just want this done. So we use 0.
You can do that. I think you'd probably want to give them at least $1, but yeah, a little investigating, like Hal, you mentioned that story. I had a story. I was working at a church up in Santa Monica, and I had a senior come in, and she had a lot of stuff, and it was going back many, many years. And this is before the internet took off. And so we wrote letters, we made phone calls, and we finally figured it out. It took me almost a month to figure it out, but I had the time and I had some training. I wanted to help her out. And so she finally came in, and I gave her tax return, and she was happy, and it was a great lesson for me. But again, I think it's really based on that site coordinator, because there's a time factor, and you can't spend 300 hours on one tax return for one VITA client. That's just not going to happen. Okay, so what we're going to do, we got through all of the entries besides that federal estimated tax. And if you remember, our taxpayer made 3 estimated tax payments. And I always tell people who are self-employed, I always tell them, make money, that's great. And then make sure you make your estimated tax payments both to the federal government and the state government. It's really important, because if you ever work with a taxpayer who gets clobbered at the end of the year and they owe $25,000 or $30,000 in tax, they're shocked and they go, what do I do? And I don't know how to put it other than, well, you're going to have to pay this. And yeah, maybe an installment agreement, but you got to get on the straight and narrow. If you're self-employed, you must make estimated tax payments if you're making money. Don't neglect that. And I've seen a lot of horror stories where people do. But anyway, this is where you enter your payments for estimated, and this is for federal. And that takes care.
Paul Abrams.
What's that?
What if they didn't make the payment on June 15th? It was a different day in the month.
Yeah, I think in that, I've had that before. I think you get close to it. Yeah, that's the best answer I can give you right now. You get close to it.
Hi, this is Carolyn. I have a question. What's the proof of the estimated payments?
When you make your estimated payments, typically it's going to be, you might do it through the website. And then of course, there's going to be a withdrawal from a bank account. And so that could be part of it. You also could write checks, and that could be part of it. Now, keep in mind at the VITA site, you're going to ask people, and they're going to tell you. And then, of course, if it sounds a little fishy or it doesn't make sense, and you explain to them, when this return is filed, if you haven't made estimated tax payments and you tell me you did, then what will happen? You're going to get a letter from the IRS. But most people know that they've made estimated tax payments. And if they forget the amount, they can contact the IRS and they can get that information. In fact, one time I made an estimated tax payment. I couldn't remember it was $5,000 or $10,000. And so I went on the IRS website, did some research. Oh, there it is. That's the amount I made. Okay, so we're now at health insurance, and we remember that Tomas, his father pays his health insurance. So good for the father and good for Tomas, who is not in the marketplace. He's not in covered California. And then the state returns are not available. When they are posted, then obviously the state of California return will populate. And hopefully that'll happen by the next time we meet, because I've got a lot of state stuff I want to share with the audience. And then, and I keep forgetting the name, so you're going to have to help me out. The gentleman who talked about how to display a tax return in our 2020 module. Who was that?
One way, go down to e-file.
What's your first name, sir?
Scott.
Scott, okay. So this is actually a student of mine, a student of mine in my class. I couldn't populate it, said, I couldn't populate it. She goes, Jerry, this is what you do. You go to paper return, you hit save. And let me go ahead and take that. Anytime it says red, you got to fix it. In this case, I'm going to fix it this way. Can you still see the screen?
Yeah.
Very good. Okay, and then you've got that, and then I'm going to hit print return. And then I'm going to display a PDF document.
Yeah, I want to see if I made a mistake.
And let's see, it's 9:59, but let's just run through a couple things. And then when we come back, we'll go through a couple other things. So payment voucher, this happens when people have, they owe money to the federal government. And you want to make sure that the individual sends that check, if they can make that payment, to the federal government. Sometimes they'll send it to the state and vice versa. And what I do is I tell them this is a federal document, and if it's a state document, I point out the state document.
Say, Jerry.
Yeah.
Do you think you're showing us that return?
I am showing you a return. What are you seeing?
That's in a different app, so you have to screen share to the return. You're still showing us the TaxSlayer screen.
All right, let's see if I can show you this. Now, can you see it?
We're seeing a payment voucher. Yes.
Bingo. All right, thank you, thank you. Okay, so here's the payment voucher. Again, I sit down with many a taxpayer and they go, what's this? And I explain it. And I tell them, send it to the IRS at this particular address. And sometimes your VITA sites will pre-address the envelope. But again, you just want to make sure, hey, this is your obligation. And then here's the 2020 return. And you can see the various items that we have entered. We've got all the administrative data for our locksmith. We've got our interest income, our dividend income. We've got our capital gains, which is taxed at a preferential rate. We'll show you that after the break. And then our total income. And then this right here, this is a 1/2 self-employment tax deduction. We're going to talk about that. But the key takeaway here is we've got our itemized deductions, which are greater than the standard deduction. We have the qualified business income deduction, which is 20% of net income. And then we have taxable income. I'm not sure what you do with your taxpayers, but if I have time, I typically will go through at least the 1040 so they have a basic understanding of some of these lines. But I do point out taxable income.
Hey, Jerry?
Yes.
Under the CARES Act, going back, scroll back up a little bit to the taxable line 10A, they're allowed to defer that to the next 2 years. How do we do that in TaxSlayer?
The answer is I do not know, and that's something we're going to have to navigate probably in the next week. When we meet on December, I think it's December 5th, some of those questions I will have answers for you.
Okay, thank you.
And of course, and you're going to do what you're going to do. If someone says, Jerry, should I defer? I would tell them you should not defer unless you are in financial distress, because when you defer something, what that means is a year from now or 2 years from now, I got the idea of time value of money, but you still got to write a check. And when you defer something and you got to write that check a year or 2 years from now, whoops, you haven't budgeted for it. So that'd be my recommendation. But yeah, you're right. They can defer it. They can defer it for I think half for 1 year and half for the next year. Okay, moving on. Again, we're tax on line 16. This is a tax that's calculated. Sometimes people say, hey, how do you calculate that tax? Well, the answer would be you would go to the instruction booklet of the Form 1040, and then you also have to consider the amount of that capital gains, because when you have something that is long-term, that essentially is taxed separately from the other type of income. And we'll show you that. Here's the total tax. A lot of people, when I ask them, hey, did you pay any tax last year? They always say, I got a refund. And I tell them, you should go to your tax return where it says total tax, because, and it's even in black font, darkened black font, bolded font. That's what this person paid in tax. So that means they're contributing to the system. But a lot of people, they're focused on the refund. I got that. I like money too, but they have a tax liability, and this guy paid it, or he paid most of it. And then you can see the amount of estimated tax that's applied to what he owes. And then he has that remaining amount here. And then one last thing before we take our break, we do have the ability, or the taxpayers have the ability for direct deposit. I highly encourage it, because when you file a tax return and you wait for a paper check, it's not going to come next week. It'll probably come in a month or 2 months. And sometimes people steal money out of or checks out of your mailbox. So do direct deposit. I think it's the best way to go. And most of our people agree with that. Okay, folks, hold your questions until we come back. I've got 10:04. Let's come back at 10:15, and we'll finish up with this return. Thanks.
And for the client who wants to say, I don't want the IRS to know my checking account number, I tell them, trust me, they already know it.
They sure do.
Hey, Quintina, can we unrecord right now? Thank you.
queue, just pause it, okay? Don't stop, but just pause. You get that cue? Thank you, love. Susumat. Gawa ng pot.
Bakit naririnig ka nila?
Nakamute. Hindi ko. Saan? Ako yun?
Well, you're not.
Thank you.
Yep.
I'm 33. Oh, what's it? That's it.
Jerry, Bill wants to see the summary of the 1040.
Bill wants to see the summary of the 1040.
Yeah, you can show the 1040 form, or there's a place to say show summary review. Click on summary review. You can just see it doesn't come out like a 1040 form. It just comes out with some line items.
Yeah, I'm familiar with that, but we're about ready to get started here.
Oh,
so
okay. All right.
Stay with this document.
Jerry, my name's Julie, and I just wanted to add that he also can deduct sales tax. He can do that calculation for California sales tax that he paid over the year, and that would reduce his taxes even more. And so on the chat, I put in the web page where you can click on and go and calculate that deduction and then put it on the Schedule A.
Yeah, and we talked about that last week. You can take either the sales tax deduction or the state and local tax.
Yeah, because he doesn't pay income, California state, he doesn't have that deducted from his paycheck. So he doesn't have, I mean, if he had state income tax, he could use that or the sales tax. Since that wasn't on the sheet you gave us, either one, I just plugged in sales tax.
Okay, yeah, good deal, good deal. Okay, it's 10:14. We'll get started again. So we're still on Thomas Silva, and one individual mentioned that Tomas Silva, because Tomas doesn't pay any state income taxes, he doesn't have a W-2 job, then he can take the sales tax deduction on the Schedule A. And so that's something we talked about last week. And so you want to make sure that that you do keep that in the back of your mind when you see taxpayers who are in a situation like this, or their sales tax deduction is greater than their state tax that they've paid. Okay, so back to our return. We're now on the Schedule 1. You can see the amount of the business income, and that's called net income on the Schedule C as in Charlie. And then you can see on the adjustments to income, there's a number of adjustments, but the adjustment that he's entitled to is that 1/2 self-employment tax deduction, which is calculated automatically and shown on the schedule here. Our additional tax, this for your new self-employed individuals, sometimes this is quite surprising. Their questions will be, why do I owe self-employment tax? And I tell them the reason you owe self-employment tax is there is a law that was passed when back in the late 50s or mid 50s called the Self-Employment Contributions Act. And what that means is a lot of employees pay FICA under the FICA Act, Social Security Act. Self-employed people pay under the Self-Employment Contributions Act. And again, that's about 15%. It's on the Schedule SE. And for your new self-employed people, sometimes they just don't understand that. And so you just explain this. This is the monies that are going to essentially go to your Social Security account. And then when you reach a certain age, and if you qualify, then you'll be able to get Social Security benefits. Okay, here's your Schedule A. And again, we did talk about, yes, you can take sales tax as opposed, excuse me, the sales tax as opposed to the state income tax. There's our gift to charity. I'll put a couple things on the Schedule B. Yes, your interest and dividends. At the very bottom, if they have a foreign bank account, you want to ask them, do you have a foreign bank account? And if they say, yes, I do, then you want to indicate that in the software. Here's your Schedule C, also known as perhaps a, and you have your profit and loss statement. So you have your income that you reported. You can see that very generous deduction for vehicle expense. And then here's business insurance and his other expenses that appear. And then if you go to page 2, cost of goods, we don't do that in the VITA program, but the information on the vehicle, it's populated there. And then your other expenses.
Jerry, I'm sure, can you scroll back up to Schedule C for a second?
Sure. What would you like to look at?
I was looking, I have $500 on line 18 and I think you don't. Okay, I'll have to go and find out why I have an amount there.
Yeah, let me go back to the return here and see the expenses. We had work clothes, $500, and we also had cell phone expense, which is not deductible.
I don't see a vehicle deduction there. Sure.
If you go to line 9, it says car and truck expense.
Oh, it's over there. Okay, thanks.
Jerry, I'm sorry, you said the 500, okay, that's where my $500 is that I didn't take. Those are not deductible.
The work clothes are deductible, but the cell phone is not. Okay, so again, back to other expenses. And then capital gains and losses. If you have someone who's experienced, we're talking about a taxpayer, you don't have to spend a lot of time in this document, but if they're not, then you explain the difference between short-term and long-term. In this case, he had $500 in long-term. And then at the very bottom on line 14, if they have carry forward from a previous year, that's when you're going to ask for that, that tax return, and then you'll populate that area. And let's see here. And then here is your 8949. And again, this talks about long-term, which is taxed at a preferential rate. Here's your self-employment tax. For the new self-employed individual, this is something that they want to make sure they have a basic understanding because they're going to be paying this. on their net income if it's more than $400. And you can see the deduction for the 1/2 self-employment tax deduction on line 13. Here's your qualified business income deduction there. I tell people it's 20% and most people qualify. So that's a good thing for them. This generated, and since it's generated, probably good to talk about. If you can't file your tax return for whatever reason, you can file for what is called an extension, but you want to make sure you make your payment so you don't get penalized there. And some people extend all the way, usually to like maybe the 15th of October, and that's important. Again, if they cannot get their documents together and they can't file their tax return. Okay, any basic questions before we move on?
Hey, Q, are we recording right now, Q? Thank you.
All right, here we go.
I have a question. Back on the summary page of how much of the AGI and of the amount they owe, what figure would show up is they owe $430 and the AGI is $32,573.
I don't have the summary page in front of me, but whatever was on the tax return, that's it.
Okay.
Well, we can't see it.
Okay, we are marching on, ladies and gentlemen. So the standard deduction, this is something that you don't have to memorize because it's all going to be done automatically, but we want to point out a couple things. That standard deduction, depending on your filing status, it's going to change year to year. So for tax year 2019, that single standard deduction, or the standard deduction for the single filer, was $12,200. Well, it went up $200 for tax year 2020. So you can see there are changes. And then, of course, for your seniors who are over 65 and your blind taxpayers, they're going to get an additional amount for that standard deduction. So, for example, if you have a married couple, let's say they're both 70 years of age and they are both blind according to the definition, the tax definition, and they file a joint return, they're going to be able to get a standard deduction of $30,000. And that's right out of your publication 4012. Page F2. But again, you don't need to memorize this. I don't memorize this stuff because the software does it for me automatically. But when people ask you, why is my standard deduction this? You can explain to them, here's your standard deduction for most people, but because you're over 65, you're blind, or maybe someone can claim you as a dependent, then you have a different amount. Again, in the publication 4012, page F2. Let's talk about blind. Total blindness, I had to look this up and I kind of figured I was right. It means you have no vision at all. And so if you have no vision at all and you're filing your tax return, then you get that additional amount on page F2. If you cannot see better than 2200 with corrected vision, that's also a definition of being blind. And then if your field of vision is no more than 20 degrees, and for lack of a better term, I think that's called tunnel vision, then if you meet that, and of course, you would have to, if you're going to have the 2200 to the 20 degrees, you would have some type of eye doctor, I think they're called ophthalmologist or optometrist, who would make that determination. But again, that's a definition of blindness. And then, of course, standard deduction, that's when you're going to have that young adult typically working, making a few $1,000s a year. Mom and dad can claim them on the return, but that young adult wants to get their refund, so they're going to file their return, and their standard deduction is going to be a lot less than what's shown on the standard deduction for single. And that's, again, explained on page F2. And like you tell people, and this is what I do, I tell people the software will do it for you automatically. You just have to indicate whether or not the person's blind. And of course, you're going to put in the birth date for the age if they're over 65. Let's talk about the child and dependent care credit. If you've had a chance to get into the publication 503, IRS publication 503, it does a really good job explaining about the particular credit. And so you probably, if you're new to VITA, and I think there may be one or two people that are new to VITA, it's a non-refundable credit. And so what that means, non-refundable is a dollar for dollar reduction of the tax. And then if you look at tax credits in the whole, there is what is called an order of tax credits. And you don't need to memorize that. It's in the computer. All you're going to do is enter the data, and then those particular tax credits will, those non-refundable credits will be used against tax. So the rules are you have to have a qualifying person, and typically, not all the time, but typically it's going to be a kid under 13. And so what that means is you're dropping your kid off at some type of daycare or some type of care facility, and they're watching your child while you either work or look for work, or in the circumstance of what are called the deemed earned income, there's an amount that's going to be assigned. But the bottom line is, for our purposes, typically you drop them off, you're going to work. Also, you may have someone who is incapable of self-care, and that person can be over 13 and incapable of self-care. It means if you leave the house, they're probably going to hurt themselves or hurt someone else. And so they need care, and that's just the way it is. And so if you're paying someone to care for that adult or that person over 14, then of course you'll be entitled to this particular credit. And then when you talk about the work-related expenses, the max is $3,000 for one child and $6,000 for another child. And this is something that I've seen before, and if you have this experience, please share. You can make payments to relatives. That's okay, but there's exceptions where those relatives cannot be paid and you cannot get the credit. And so you can have relatives, those relatives can even live in your home, but you cannot claim qualified work-related expenses when you're paying money to a dependent or your kid who's under 19 or your spouse. So those are some items you can't do it. And again, the Pub 503 does a really good job. And then when you talk about earned income, well, you have to, the general rule is you have to have earned income and you have to have a certain amount of earned income to be eligible for this particular credit. And there's a thing called deemed earned income. And the deemed earned income, if you go to your publication 4012, page G, Golf 12, it talks about that dollar amount that's assigned to someone who is going to school or they're disabled. And in that case, they're dropping their kids off. Kids are being watched because you've got a person going to school, a married couple going to school. So there's a plug amount or a deemed earned income amount. And again, you can find that on page Golf 12 in your publication 4012. I've seen that a few times, not a lot, but it's there. And the Pub 503 again does a great job. Dependent care benefits, this is something that'll be reflected on a Form W-2. And if you go to page 2 of the 2441, that's where you're going to plug in them out. So dependent care benefits are simply this. I never got them, but you might have someone who works for an employer. The employer pays benefits up to a certain amount. And then the taxpayer, the idea is they're going to use those benefits to pay for child care. Well, if they don't use the benefits to pay for child care, then it's going to be income to the individual. But when they do, then you're going to plug in that amount on page 2 of the 2441 in the software. Oh, I should have asked, Violetta, can you see the PowerPoint presentation? Can you come off mute or give me a thumbs up?
Yeah, sometimes I'm using only a Galaxy, so it's sorry.
Can you see the PowerPoint presentation that says child?
I can see it, Jerry.
Excellent. Okay, very good. Okay, so once again, dependent care benefits, I've seen that from time to time, and it'll be reflected on the W-2. And again, you got to plug that amount in on page 2 of the 2441. So when you go to the software, it'll bounce you to page 2, and that's when you have to enter that data. So let's talk about child care providers and what are called taxpayer identification numbers. Your kiddie cares, places like that, they're going to be, typically they're going to be incorporated, or they might be a partnership, they might even be a sole proprietor, but they're going to have an employer identification number because they're going to have employees. And when you go to that particular care provider and say, hey, I'm ready to file my return, I need information from you because I have to enter that data into my tax return, because the IRS requires it. And so you're going to get that. Now, what you can do, you can ask the provider to fill out an IRS form W-10, which is called a Dependent Care Providers Identification Certification. And again, all you're looking for is the name of the care provider, the address, and then some type of EIN or SSN. And then what you do as a taxpayer, you'll keep that for your records. And then here's something that's described not only in the publication 17, but also in the publication 503 is the due diligence. And what that means is if you have a care provider who will not give you their social security number and you're making that, that bona fide attempt to secure it, then you're not going to put them in a full Nelson until they give you the number. You'll say, okay, well, you'll explain, I need your SSN because I'm filing my return. And if they say, nope, you're not going to get it, okay, you got their name and you got their address, you've done the due diligence, and you're going to tell the IRS, this is the information that was given to me. I try to get the SSN. That happens from time to time. Now, if I remember correctly, and someone jump in if I'm wrong, I do not believe you can file electronically if you don't have some type of EIN or SSN. That's what I remember.
And I think California also wants a phone number.
Yeah, yeah, oh yeah, yeah, and you want a phone number. So you got to get that data. So do the due diligence. And then this is what I tell people. Obviously, someone who's a daycare provider, what happens is all this data is entered into the big computer in the sky. And then what the IRS will do, they will generate a letter to the care provider and say, dear care provider, we have information that you have received approximately $20,000, $30,000, $50,000 of income. We don't see a return that has been filed. And then what would happen, that care provider then would most likely be examined by the government. And that's called a whipsaw effect, where you're doing something and it affects someone else. That happens in divorces where people used to pay alimony or paid alimony, and the individual took a deduction under the old rules, and the individual receiving the alimony did not report it on their return. And so that's why the IRS will look at both returns, again, called the whipsaw effect. So due diligence, typically though, when you're dealing with a care provider that's a kiddie time or tutor time, whatever they call it, they're going to give you all that data. So you're able to not only file a return, you're able to file that return electronically.
Hey, Jerry, I have a question. If you have a care provider who's in a single proprietor and it turns out that they don't give you their social security number because they don't have one, maybe they're either a legal or illegal immigrant and they don't have permission to work in the country, does that wind up impacting your taxes? Or if you're an illegal employee, do you lose the ability to deduct? Or
no, if you have someone who's undocumented watching your kids, then they may not have a social, or they may not have an ITIN, an individual taxpayer identification number. So you're going to get all that information, you're going to file your return, and again, it may be a paper return. And then what will happen is that whipsaw effect will come into being. The IRS will write that individual, and if they're undocumented, but they're living and working in the United States, they may meet the substantial presence test, which means they should file a Form 1040, just like you and me. And so that letter will go out. And I used to audit undocumented individuals when I worked up in LA, and they knew the rules and they knew that they met the substantial presence test. And so, yeah, they had to file and pay their tax. Okay, let's see. I think that pretty much takes care of this particular screen. So, one other rule, of course, when you're talking about meeting the rules for a qualified person, they have to live with the taxpayer for more than half the year. So that's yet another rule. And we see this a lot at the VITA site. And if you've ever looked at the table, of course, we don't see high income taxpayers at the VITA site, but if you have a taxpayer who's making $500,000 a year and they meet the rules, they're still going to be entitled to this particular credit. This is one of the, I think this is maybe the only credit, one of the few credits where you can make a lot of money, and if you meet all the rules, you can still get some of the credit. You're not phased out because of your income. Okay. Let's go to education credits.
Hey, Jerry.
Yeah.
There was a question in the chat. I want to make sure that people reply to that. There was a question about on the chat about someone, if someone leaves to go to volunteer and leave his child or her child to a daycare or a daycare provider, can he or she be able to deduct that, or what's the rule for that? That was in the chat, so I'm just.
Yeah, I think the short answer for that is the concept is you're dropping your kid off to go to work, meaning you're generating income. If you're a volunteer, you're not working for any money. It's pure volunteer work. But you're not going to qualify for this particular credit. It's just like if you dropped your kids off, you want to go clubbing with your friends, and you obviously can't take your minor child to the bars and you go bar hopping. That's not going to be an allowable expense because it has to be work related.
Thank you. So for the future, if anybody wants to raise their hand and ask questions to Jerry in the chat and nobody replied to the chat, just feel free to unmute yourself and ask the question. All right,
yeah, you can do it that way because I'm not checking the chat. That would interrupt my presentation, and I would curl up in the fetal position and start crying. Okay, education credits. This is very popular at the VITA site, and typically you don't have an issue with educational institutions, but there's a definition, and it has to be some type of schooling after high school. The term is post-secondary education, and typically that's going to be a college or a trade school or a university. And what's important, in order to get the education credits, we're talking about the American Opportunity Credit and the Lifetime Learning Credit. These schools, these post-secondary schools, they have to participate, or they have to be eligible to participate in what is called the Student Aid Program. That would be the grants and the loan program that's administered by the U.S. Department of Education. And so what you can do is this database of all these schools is obviously a very comprehensive database, thousands and thousands of schools. And what it is you, if somebody gives you a name of a college or a school, you can jump in here and you can find it. So what I did is, I'm familiar with Saddleback. So I entered Saddleback and it came back. Yes, it's part of the program. And then I read about another school called the University of Honolulu School of Law, but they're in Modesto, California, and they're not eligible. And so you can go in there. Now, let's do this. Let me see if I can enter and you can see it on the screen. So Steve, you're back. Let me know when this thing opens up if you can see the screen. And so for example, you might have like a real estate school where you've got students come in, they pay a fee, and they go through basic real estate principles, basic real estate finance, and chances are those are not going to be a college or a trade school that's going to be eligible for these education credits.
We're still looking at your PowerPoint.
Yeah, I got what is called the blue circle of death. So I think what I'm going to do, I'm going to stop. We're going to come back and we're going to go ahead and jump back in the PowerPoint. Oh, do you see it now?
No, we're looking at you.
Okay. Well,
nice beers.
I'm going to close this bad boy out. At least you've got the URL. You can go ahead and at your leisure, you can look up the school, maybe the alma mater that you went to.
It flashed there just for a second.
Okay. Can you see the PowerPoint now?
Yes.
Excellent. Okay, let's get to the actual education credits. There's two of them, and most of you are probably very familiar with these credits. And you can go to the Pub 970. That Pub 970 has a bunch of examples, a bunch of scenarios. And if you have time, take a look at it because you will definitely get yourself educated. But anyway, let's go to the credits and talk a little bit about them. So we know that typically what's going to happen is that taxpayer is going to have an information return called the Form 1098-T as in Tango. And what I do is they hand me a document and then I start asking questions. They go, well, wait, I've already handed you the document. I tell them, that's right. And there's probably other expenses that we're going to find. And so that's why you do that interview. But anyway, the 1098 is your starting point. And on the 1098, you're going to have information pertaining to tuition that was charged by the school. And then typically you're going to see scholarship information if the taxpayer received any scholarships. And so what you're going to do, you're going to net that. So for example, let's say you have someone who has received, let's say they've got tuition that they have to pay of $7,000 and they get a scholarship of $5,000. So out-of-pocket expenses is $2,000. That $2,000 would be used to calculate the credit Those are what are called the qualified educational expenses. And then in addition to that, if they had books that they paid out of pocket, you add that, or maybe course materials. And so we know that the American Opportunity Credit is good for 4 years. You don't have to be consecutive. And so if someone takes a break and goes back, but it's 4 tax years, and after that, they can't use that American Opportunity. They have to go to either lifetime learning or something else. You can't have a felony drug conviction. I'm not sure why Congress put that in place, but it's in place, and you got to ask the question. And then here's something right out of publication 4012, right out of publication 970, and right out of the Internal Revenue Code, pursuing a degree or a credential. And so what that means is you're in some type of program where you told the school counselor, I want to get a master's, or excuse me, a baccalaureate in psychology. I want to go to baccalaureate in mechanical engineering. And then typically you're going to have a path to get that degree or a credential. The only thing I can think of right now for credentials, maybe you're in some type of program and you're going to earn the credential of licensed practical nurse. And if you meet all the other qualifications, that would be a credential. So you're pursuing a credential. So if you're just going to college and you're just taking class after class, and some schools will let you do that. Like I went to a college and they said, we don't care what you do, but you got to pay tuition. If you pay tuition, we're good. And so sometimes I didn't show up for class, and sometimes, in fact, I was a graduate student and I would just take classes here and there. And I had no credential I was pursuing, no degree I was pursuing. I was just taking classes. And the school said, knock yourself out. We don't care, but pay your tuition. So again, I think the takeaway here is ask them, are you pursuing a degree? And if so, what is the degree or credential? And what is the credential? Again, to meet the requirement.
Yeah,
and then you already have time.
Yeah.
Yes?
Community colleges have a lot of credential programs that don't result in a degree. So you might run into that.
Yeah, and again, without beating a dead horse, I always tell people, I know a lot of stuff and a lot of stuff I don't know. So since you're sitting in front of me and you lived it and you experienced it, tell me your story. And then that way I can help them. Because a lot of people think, well, yeah, you should know this. No, I don't. Moving on, you have to be half-time, and you have to attend 1 academic period. And so, for example, the college I went to, it was a university, we had an academic period that was 3 weeks long. And in that particular case, if someone goes to that academic period for 3 weeks and they're enrolled at least half-time, they're eligible to meet the other requirements of this opportunity credit. And the school is going to determine the academic period, not the student. Now, here's the big one, the qualified expenses or qualified educational expenses. Tuition and fees, that's pretty basic. And then in your book, your 4012 talks about course materials. And so that would be maybe some books you purchased. Maybe you've got some, oh gosh, it could be some type of, well, that's all I can think of right now is books. Here's another one. Some people say, Jerry, I bought a computer. And like my son bought a computer and he said, Dad, can I take this education credit? Because I didn't claim him and he was over 21 or something. So yeah, you can, but what you did is you bought the computer and you're using it only for school. He goes, yeah, I got these other computers too. So I said, yes, that's part of your materials for qualified expenses. You're using it solely for your college. And yeah, so that's deductible. If you've got a computer, and that you just got the 1 computer, then you're going to have to do an allocation because, as we've said before, whatever you own, i.e. your computer, your television, you have a personal component. Or in the example of the computer that my son had, he had just the 1 computer. He used a portion of for personal reasons and a portion for school. So he'd have to go through an allocation. And I've done that before at the VITA site many times. That's my experience for that. I'll open it up for any questions or comments.
This is Julie, and I have a question because the kids that I know had to buy a Chromebook or something like that to do Zoom online classes right now because of COVID. They would never have bought it had they not been required to get it in order to attend schools online. However, the school allows them to then use it, or not the school, but then now they use it also, just because now they have a computer, a laptop, they use it for personal stuff too. So would they have to allocate part of it? I mean, they were required to buy it.
Yeah, and I'm not a computer guy, so when you say a Chromebook, what is a Chromebook? Is that software?
A Chromebook is like a laptop. It's just a different kind of laptop. Some schools use just regular laptops. When I was working with AARP at Laguna Woods, they required us to use a Chromebook, but they provided them to us.
Yeah, so in that particular
situations, the school will provide one Chromebook for the entire family, but if there's 4 kids, then they have to buy 3 more Chromebooks.
Yeah, I think that screams out that is absolutely a qualified expense. Again, you'd have to go through that allocation. But yeah, that's something that they have to buy, they have to use. And yes, there's a personal component. So I think the allocation and then that term reasonable, because someone says, well, I use it 99% of the time for school. I'm thinking, well, if you're a young adult, you're probably spending a lot of time on the computer on various social media sites and YouTube and all that. So 99% is probably not reasonable. And that's when you have that discussion. Maybe it's 40-60 or 60-40, something like that.
Thank you.
Sure. Okay, let's move on.
Paul Abrams, do the textbooks have to be purchased at the school bookstore, not Amazon?
No, not for the purposes of the American Opportunity Credit. You can buy the books anywhere you want. So my students typically go to the publisher's, website, and they buy. Sometimes they buy it from the school. Sometimes they just go and buy it from Amazon. So for the Opportunity Credit, it's all part of those qualified expenses.
But his answer will be different relative to lifetime learning credit.
Oh, we haven't gotten there yet? Stand by. Okay,
yeah, that's how I was warning him.
Jerry, I have a question about taking the American Opportunity Tax Credit. A lot of our kids that come in are going to Saddleback, and then they're going to transfer to, never mind, I just answered my own question.
All right, great. Okay, lifetime learning credit, it's non-refundable. And as it says on the screen there, max per return for everybody on the return is $2,000, and it's unlimited until Congress changes its mind. And then, yeah, you can have a felony drug conviction. I don't know why that is, but Congress came up with it, so be it. So let's look at qualified expenses. It's similar to the American Opportunity Credit. You got your tuition and fee. And then it says amounts paid to the school for course-related books, supplies, and equipment. And I guess the only example I can think of, and there's probably 1,000 out there, is I knew a guy one time, he was going to dental school, and he had to pay tuition, and then he had to pay the school another chunk of money for books, and he could only get it from the dental school. And so that's the only example I can think of. But that's the rule. That's right out of your publication 4012 for the lifetime learning. You got to buy the books from the school. And of course, most schools have a bookstore. So any comments about lifetime learning credit?
I wonder if they tell you to go buy the Chrome computer from somebody else.
Buy the Chrome computer from somebody else?
Because they don't sell it at the school.
Yeah. Well, the rule is unless there's some type of change to the regulation or a revenue ruling that comes out, I would go right back to what it says in your 4012. You got to pay it to the school until something comes out from Congress or the IRS.
Okay, thank you.
And Jerry, I have a quick question.
Mm-hmm.
I'm assuming if there's some way that you can prove that you purchased it from somebody, is it okay if you bought it secondhand as well? Would that qualify?
Are you talking about the lifetime learning credit?
I suppose for the lifetime learning credit, if you paid for something, or rather for the American Opportunity Credit, if you paid for like a book or something secondhand.
Yeah, the American Opportunity Credit, you can purchase those books wherever you want. Okay. And if those books are part of the course material. Now, a couple things. Thanks. You might want to jot this down in your publication 4012. It talks about the lifetime learning credit. You're learning work skills or you're improving your work skills, and so that's the requirement there. And also, it talks about a CARES grant. Now, I know what CARES is. I've read some of the legislation, obviously it was a lot of money going out to a lot of people. But if someone receives a CARES grant and then they use those grants, which are not taxed, and they use those grants to pay for tuition and fees, then that's going to reduce their qualified expenses. So that might come into play. And so one of those questions you'd ask your taxpayer, did you receive any grants from the federal government, and did you use those grants to pay your tuition and fees? Because again, the CARES grant is a non-taxable item.
Hey, Jerry, I have a quick question on the lifetime learning credit.
Yes.
Will those expenses that you paid to the school be reflected on the 1098-T?
I think the short answer is yes, they should be if the school is doing their job, because they're taking in your tuition money. So yeah, the short answer is yes. And then again, I always ask people, okay, I got your 1098-T, tell me about your other expenses. And they'll say, well, I've got room and board. No, you can't do that. I've got books. Oh, okay. Well, if you've got books for the opportunity credit, we're going to add that in. I bought a computer and I only use the computer for school. Like in my house, I think I've got like 6 computers. And so if I was going to college full time and I met all these rules, then I could take my computer as a qualified expense. Okay, let's go to the next one, the child tax credit. This is something I don't spend a lot of time with because for lack of a better term, you enter the age of the kid, the age of the mom and dad, all the data there, and the computer will automatically calculate your child tax credit, which is refundable. I stand corrected, which is non-refundable, and the additional child tax credit, which is refundable. And so the publication 972 does a really good job. On the return itself, the schedule 8812 is going to be generated. And then the entire credit, the max is $2,000 per qualifying child. So the kids have to be under 17. And then in your software, it says something about U.S. citizen, resident, alien, or national. They've got to be one of those. And a lot of people, I mean, I don't know, I know what a U.S. citizen is. You're either born here. That's the general rule. There are exceptions. If you're a diplomat from, let's say, Morocco, and you have a baby in the United States and you're on official diplomatic orders, your baby is not a U.S. citizen. That's one of those exceptions. But anyway, generally you're born here, you become naturalized, that's a U.S. citizen. A resident alien, that could be someone who goes to immigration, files the paper, and they have a green card, or you can become a national. And a U.S. national is someone who has a lot of the rights of U.S. citizens, but not all of the rights. Like, for example, if you're a U.S. citizen, and let's say you have not been convicted of a felony, you can vote in federal elections. A national cannot vote in federal elections. And the only nationals I can think of, there's probably an extensive list out there, but the ones that I found is American Samoa, Swains Island, which is in the Pacific, and the Commonwealth of the Northern Mariana Islands. The Northern Mariana Islands, easy for me to say, there's a lot of garment production there. And so anyway, those people who live there are generally considered nationals. They can still get the U.S. passport, but they don't have certain other rights of U.S. citizens.
Question.
Sure.
If the child of the diplomat meets the substantial presence test, does he not make him a resident alien?
No. That's an exception. There are certain exceptions. And when you're born, if you're again, the example I gave you, the Moroccan diplomat, that baby is not going to be a U.S. citizen and not going to be deemed to be a resident alien for tax purposes. No, they're a foreign national, period.
And that's because he's a dependent of a diplomat?
Correct, because there are certain exceptions that are carved out, and that baby will not become a U.S. citizen. You can actually read about horror stories where people end up staying and they're not U.S. citizens, and then they end up getting deported. Okay, next.
Resident alien.
What's
Normally, if you meet the substantial presence test, you are deemed a resident alien by the IRS.
That is correct. That is correct. But like I say, there are certain things that are carved out. Okay, so SSNs, you got to have an SSN. Your software is going to ask you about that. And then the additional child tax credit, it's refundable for low-income folks. It's a really healthy credit. You're going to see it on a return that we're going to do or demonstrate here. And then, of course, if you get into the publication 4012, taxpayers have to have earned income of a certain amount before they're eligible for the ACTC. And earned income, that's basically your wages, your net income from your self-employment. When you hear the term unearned income or portfolio income, that would be like dividends and interest. All right, the credit for the other dependents, this was new as of 2018, and the Tax Cuts and Jobs Act established this credit. It's going to be good for 7 tax years unless Congress extends it, because the sunset would be at the end of 2025. It's a $500 credit, non-refundable. Kids have to be under 19, or if they're full-time student, determined by the university or the college, under 24. And if you have a disabled child or qualifying relative of any age, they can get this. And then, of course, like the other rules, they've got to be a U.S. citizen, U.S. national, or a U.S. resident. And that's, again, that's one of those newer credits. Okay, I'm gonna hesitate for just a moment here. If you have any questions before we jump into the Franklin and Isabella Harris return. Any general questions?
Hey Jerry, what time is the next break? I just wanna gauge one.
You know, as a former government employee, we used to love breaks. This is a good time for a break. So well, let's do this then. If there are no questions, why don't we come back at 11:05 and we'll jump into the Harris return.
Hey, Steve.
11:05.
Pause the recording.
Steve, can you hear me?
That's what
it's actually part of the advanced test. It's one of the scenarios in the advanced test.
What's one of the scenarios in the advanced test?
Franklin and Isabella Harris, I think.
No, it's not. It's something.
It's not? Well, because there is a Franklin Harris in the advanced test.
Yeah, be careful. It's Harris Franklin on the advanced test.
That's true. That's true. That's
the one
true.
that I generated is a Jerry Muir generation.
It was very confusing to have both those in my menu on TaxSlayer.
Hey, Bill, that was mailed to us from by Fred via email.
Well, I'll look for it again, but I got the one for Whitney Jackson, but I didn't get this one. But I'll look again. Maybe I just overlooked it. Thank you.
The email went out at 9:52 p.m. on the 19th.
Plenty of time to prepare that return. Probably take you about 5 minutes.
Yeah, sure.
Bill, I just this is Arnie. I just forwarded the email to you with the tax return attachment. or the problem, I should say.
Steve, are you back with us?
I am still on my cell phone, but I can see your screen.
Okay, all right. Well, I understand your daughter's doing an excellent job.
Oh, I hope so. So right now it's I think it's back to recording.
Okay, good. Okay, we're going to get started again, and so hopefully you got that recording going. And so what we're going to do, we're going to talk about the next practice return that went out the other day. This is the Franklin and Isabelle Harris practice return, and it includes various topics, the credits that we've talked about today. So we've got our taxpayer, who is an administrative assistant and married to his wife Isabella, and she's a licensed practical nurse. And we've got W-2 information for the husband. He works at a t-shirt shop, and he has earned wages of $15,000. He also has health insurance that the employer pays for, and that's reflected on his W-2. The wife, she works at a hospital, and she has wages of $18,000. And then they have a little interest and dividend income. And then they got some prize income. And in this case, they won the prize. They received either the check or the currency, but no information return, no W-2 or 1099. And then they have a minor child. Her name is Fiona. She's about 5 or 6, and they drop her off at the Kindy Kid Care. And that's a place where they watch kids. You pay them, and they'll watch your kid for you. And of course, this couple drops off their child when they have to go to work and school is not in session. So they have to have some responsible adult watching the child. And they pay $2,700 in 2020 for the child care center. And then they've got another dependent. His name is Ernest, and Ernest goes to college full-time. He goes to Jim Thorpe College, and it's qualified for education credits, and he's going to take the American Opportunity Credit. He goes full-time his first year, no felony convictions. And then in addition to the 1099-T that was issued, he did have college textbooks that he purchased out of pocket, and that was $400. And then he also tells us that he paid $250 for a yearly campus parking pass, and we'll be talking about that. And if you can see on your screen, this is the 1098-T information, excuse me, where it says the box 1 amount. That's the amount that the school billed in tuition. And in his case, in box 5, that's the amount of a scholarship that this young man received. And so what we're going to do when we go through this, we have to net that, which means we have to subtract that $2,200 from the $4,500. And then we have to add in the books. And that's how we're going to get the qualified education expenses. And then also he did not receive a 1098-T for 2019. So that's our scenario. Let's go to our software and give me a moment here. All right, and Violetta, you're the only one on my screen. Can you see the practice lab?
Yes.
Okay, thank you.
Yes.
That's a very deep voice, Violetta. Okay, so again, 2020 tax program, that's the year we're working with, and we're going to go ahead and go to that return. Okay, so we've got Franklin Harris. And so I'm going to go ahead and ask some questions. We've got about 50 minutes of discussion here, so let me do this. Let me do this. And these are softball questions. If you don't know, just say, I don't know, and we'll move on. Adela, can you come off mute?
Okay.
Adela, when you're talking to a taxpayer about filing status, what document can you use to guide you along to make that decision about their status?
Well, you can go to the 4012, the decision tree.
Correct, the decision tree. That's correct. And then we've mentioned before, I've seen this in the VITA site. If someone doesn't want to file jointly with their spouse, there's no requirement. The Immigration Service can't make them. The federal government can't make them. A judge can't make them. The filing of a joint return is purely an election. You choose to do it. Now, of course, if they don't choose to file a joint return, then in the VITA site, we can't help them out. Like I had a client who refused to file a return with her husband, a lot of issues. And I said, well, then what you're going to do then is you're probably going to go down to that married filing separate, which we can't help you out with. So I mentioned she should go out in town and find a paid practitioner. Okay, so we're back to our Franklin and Isabelle. We've got our administrative data. And you can see the screen. This guy is born in 75. And his wife is born in 76. Okay. And we've got our address. And in the software, if you don't put any phone number, then you can't go forward in the software. So typically your taxpayer is going to give you their cell phone number or maybe their telephone number at work. Okay, we have dependents, so we're going to go into our dependents. And we've got, whoops, I think I hit the wrong one. Hold on a second. Okay, let me continue. And we're going to go to our dependents. And we've got 2. And so as we've said before, the blue pencil means you're going to edit information. The red garbage can means you're going to delete it. And I can't tell you how many times I've been in a return and it's all convoluted and it's not making sense. And so I just go ahead and hit the red garbage can and re-enter data. Okay, so here's information for the son. This is the college student. And here's that verbiage about a U.S. citizen, U.S. national, or a resident alien. And in this case, he's over 18 and he's a full-time student at a qualified educational institution. And then we have the young daughter, Fiona. She was born in 2014, and she's a U.S. citizen, and she does not go to a college, and she's not over 18. And we're going to uncheck that. That's my finger doing that. Okay, so we entered data for the dependents. And if you go to your scenario, then we have W-2 information. And just a quick mention again of the IPPIN. If you have that, the individual then can file electronically. So that's a plus. Here's our W-2. And we've entered data for the t-shirt shop. So let's take a look at that. And in some cases, you've probably seen this if you're a returning VITA volunteer, you might have taxpayers with 3 or 4. I think the most I've ever seen is 17 W-2s from a taxpayer, but typically they'll have 1 or 2. Okay, and this guy, he works for the t-shirt shop, And you can see in wages, he's got $15,000 of earned income. He's got withholding of $1,500. Box 3, 4, 5, and 6 auto-populated. If those boxes are different than the W-2, you can make those changes. The software will accept them. Box 12 again, typically the only codes you're dealing with is Delta, which is health insurance, and then Delta, which is deferred compensation. Those are typically the two that you'll deal with. Now, so that means the employer pays for insurance for the taxpayer. And then down at box 14, these are your occupational insurance, i.e. compulsory insurance. And not every state in the union has them, but California does. And you can see right here, if they're paying into SDI, then that is a tax and it will be carried forward to the Schedule A as an alpha. And then California, although we're entering this data because it's not fully loaded, the California return is not going to generate. But here, as I mentioned before, state wages typically would be the same as federal wages, but not always, but typically. And then state tax paid simply means state tax withheld by the employer from the employee. And then, of course, that will also roll over to the Schedule A as an alpha. And then I think we have like 70, how many people do we have on the call?
75.
75 people. That means a lot of brain power out there. So can someone tell me, is there a jurisdiction in California that has a county or city income tax?
Santa Monica?
Santa Monica has an income tax?
I believe San Francisco does.
Yeah, I don't think so. I looked it up a couple days ago, and the only jurisdiction I could find in California is the state of California. There are no counties or cities that have an income tax. So, but
yeah,
hey,
I don't think so. I think it happens in New York.
What's that?
Don't tell them.
What's that?
Don't tell them.
Don't tell them what?
That they haven't taxed us, or else they might.
All right, anyway, here's the takeaway, ladies and gentlemen. In the state of California, there's no local income tax. There's no county or city that has income tax, but there are other jurisdictions, the District of Columbia, the City of New York, Lansing, Michigan. Now, we don't deal with those returns, but you might have someone who has paid a local income tax. All right, moving on.
Really fast, Jerry. I see it seems that the city of San Francisco does have a city income tax.
You know, that would be great. Hey, shoot me an email, send me a text, and give me all the details, and I'll look it up. And that will be cool for purposes of teaching the class, because I haven't seen that before. I don't believe it, but if you prove it to me, then I'll believe it.
Sure thing.
All right. Okay, moving on. We got the information for the taxpayer spouse, and I've had this discussion with people. I don't argue with taxpayers. I'm well beyond that. Some people say, well, I want to be first on the return. I'm thinking, all right, fine. Doesn't matter if it's the husband or the wife, doesn't matter. Whoever wants to be first is first. It's still a joint return. And if you know anything about a joint return, it's called joint and several liability. You're both on the hook for the tax, regardless of who is first or who is second. Okay, back to Isabella. This is her W-2 information. She's got wages of $18,000. Her tax withheld is $2,000. Box 3, 4, 5, and 6 auto-populate. Down here for Isabella, she pays into the state disability program. And if you're not familiar with that program, what happens is you pay into it, and not all wage earners in California pay into it. Like, for example, when I worked for the IRS, I was a wage earner. I never paid a penny into it, but a lot of people do. And then what happens is if you become sick or injured and you qualify, then what you can do is you can request disability payment from the state, which is a non-taxable event to you because you pay the premiums. And then the data here for the state of California, again, state wages are typically the same as federal wages. Box 17 is state income tax withheld. Okay, and then we go to our next page, which talks about the interest and dividend income that the taxpayers have. And this is pretty basic. And I've had this discussion with people. They go, Jerry, I did not receive an information return, a 1099 INT. And I tell them, everything I've learned, simply because you didn't get an information return, what happened is you did receive the income. And Section 61 of the Internal Revenue Code says you're going to report your gross income unless otherwise excluded. And that's the way I do it. But generally, people will have a 1099 INT. And if I remember the rules correctly, if it's $10 or more, then the bank should generate a 1099 INT. Here's your interest income. Your early withdrawal penalty, if you have that typically will be reflected on the 1099 INT. That's when you cash in a certificate of deposit. And then every once in a while, you're going to have federal tax withheld on a 1099 INT. And if that's the case, you just enter it there. And then sometimes you'll have foreign tax that's been paid. And if that's the case, you can enter it here where it says foreign tax withheld. These other boxes, I've used them once or twice, but typically in the VITA program, you're not going to use them. Okay, so we're going to come down here. We've entered the interest for Chase Bank, and we're going to go to the dividends. And in this case, and I think we mentioned this before, some people have what is called a dividend reinvestment plan, a DRIP. If they have a DRIP, then what happens is when dividends are paid by the corporation essentially has received an order by the shareholder to take those dividends and buy additional shares. That's called constructive receipt of income, which means a 1099 DIV should be generated, and you're going to have to report that in the year you constructively receive the dividends. In this case, the 1099 DIV says ordinary and qualified, so we plug that in. And you're probably not going to use any of these other boxes down here, maybe with the exception of non-dividend distributions. I've seen that a couple times before. But again, the general rule is you key it as you see it. And I'm not shy. If I don't know something, I'll say, I don't know that. And then I'll ask the person, if you know something, you tell me what it is and we'll look it up. Because there's just a lot of stuff. I mean, as I go through the tax world, in fact, as I go, year by year, I realize there's a lot less that I know. I used to think I know a lot, and there's just so much stuff in the tax world. But thankfully for the VITA program, it's a narrow focus, and we can usually get through most returns without a lot of drama or trauma.
Typically, a non-dividend distribution is a return of capital, so it reduces your cost basis for your stock.
That's a good point. Return of capital, there's no tax consequence to return of capital. It's kind of like taking money out of your bank account. When you take money out of your bank account, do you have income? No, you have a basically return of principal. Okay, we're going to look at, how about the other income? We did not talk about that prize. So let's see if we can open that up. And in this case, cash prize, we mentioned before, if you receive a prize of a television or a bicycle or a motorcycle or an automobile, if you want to report the amount that's typically reported on the 1099 MISC, you can do that, or you can report the fair market value, same make, same model. I've seen that before in a number of cases, and of course, the taxpayer simply wants to document the fair market value if they're going to report that. And will they get a letter from the IRS? They probably will. I've gotten letters. They can respond either telephonically or they can respond by a written notice, but nothing to be afraid of. And I think the example I gave, you want a car of, let's say the car was $30,000 and you get an MISC for $30,000, and then you determine the next day the fair market value of that vehicle, same make, same model, same options, and let's say it's $24,000, then on your tax return, you can report the $30,000 from the MISC, or you can report that $24,000, which is the fair market value. Okay, so we reported the cash prize, and now we're going to go to child care credit, and this is our next one. And let's see, let's get some, how about Anna? Anna, can you come off mute? Are you able to do that, Anna? Anna Abrams?
Yes.
All right. Anna, do you have an example of the return scenario?
Yes, I do.
Great. Can you read on the page where it says under prize income, when taxpayer and taxpayer spouse?
Hold on. Oh, okay. Price income, one cash price from contest, $150. No W-2 or Form 1099 issued.
Okay, we've taken care of that. And can you read where it says we're taxpayer and taxpayer spouse?
When taxpayer and taxpayer spouse are working in school for their daughter, Fiona is not in session. They drop her off at Kindy Kid Care, an EIN number and the street number, and total pay to Kindy Kid Care in 2020 was $2,700.
Okay, thanks. And so we've got a little girl, she's dropped off when parents are working, and little girl lives with mom and dad more than half the year. And so that $2,700 is going to be used to compute the credit. And so what we've done is I plugged in the 2,700, and then I've entered data for the particular organization, which is KindyCare. And as I mentioned before, with the KindyCare or the tutor time, they're going to have typically an EIN. If you have someone who's caring for the child and they're a sole proprietor, typically they're going to give you their social. If they're an ITIN holder, then they'll give you the ITIN. If they don't have anything, then of course you do your due diligence and you're still going to be able to take the credit. So we've entered the data for the particular care facility, and this is the amount paid to the provider, the child care provider, $2,700. And then also in your book, in your 4012, it talks about if you have someone who's receiving dependent care benefits, it'll be reflected on the W-2. And then when you enter data into the software, on page 2 of the software, you're going to enter the amount that's reflected on that W-2, the dependent care. And then we had one of our participants mention for the state of California, you're going to enter that phone number. And I would submit to you, if you're dropping your kid off to a sole proprietor and they don't give you their phone number, I would submit to you that something's probably wrong. You probably want that data. Okay, so we've got that. We've entered the amount and we've got our dependent. And that is Fiona, the young daughter. And then what about, let me ask this question and let's see if we can get someone to participate. How about Arnie Herrera? Can you come off mute?
Yes.
Arnie, why do you think we only have Fiona, the young daughter? Why not Ernest, their son? Why couldn't his name appear also here?
He's over the age of 13, and he doesn't say like that he's unable to take care of himself.
Right, he's over 13. There's no data about being disabled, and there's no data about monies being paid for him. So just the daughter. Okay, and then we got the qualifying person. If you had to add someone, let's say Ernest was young, let's say he's 12, and monies were paid to watch him while the parents were working, then you would add another person. Page 2 of your software, this is page 2 of the 2441. And down here is where you've got information pertaining to benefits, employer paid dependent care benefits. And so you want to jump in your page, or excuse me, your publication 4012, and then that way you're prepared for that when you see that on a W-2. Okay, so we're going to enter that. And what else do we have? We get the information from Jim Thorpe College, and that would be that education expense for the son, Ernest. And as we've mentioned before, usually the qualified educational institution, that's not going to be an issue. And sometimes people will say, well, I went to real estate school and I took all these classes and I paid all this tuition and I did that to get a job. And that's great. I mean, it really is great, but it's not going to qualify because it's not a qualifying educational institution. They don't participate in the U.S. Department of Education grants and loan program. So here's our qualified expenses. And once again, if you go to your last page for the taxpayer, or I should say Ernest, you can see where $4,500 was paid in tuition. And then Ernest got some type of scholarship for $2,200. And so obviously that $2,200 was used to pay some of that tuition. And if you do the netting, the difference is $2,300. So that's out of pocket for tuition for Ernest. And then you have $400 for textbooks out of pocket. So $2,300 plus $400 equals $2,700. And then let me ask someone, how about Carolyn, or is it Caroline Coleman? Can you come off mute?
Okay.
So is it Carolyn or Caroline?
Carolyn.
Carolyn, why would the $250 parking pass, why would it not be included in qualified education expenses?
Because it can't be, because it can be used for something else.
Well, I guess the short answer is it's not considered qualifying because qualifying would be tuition fees, course materials, books, and things like that. And I got the fact that when you drive on these campuses, a lot of them will charge you for parking, and if you don't pay parking, they'll tow your car. I got that, but that's simply not one of those expenses. Just like when I went to college, I was in a fraternity, and it was mandatory to drink beer in my fraternity, but I couldn't deduct beer as a qualified educational expense, even though we drank it in the fraternity. So it's just, that's just the way it is. No room and board, no parking passes, none of that. And then you might also see a situation where someone borrows money and they take custody of that money. Now it's their money, although they still have a debt, and then they use that money to pay for tuition, fees, and books. In that case, they can still take the American Opportunity Credit or the Lifetime Learning Credit because it's their money. They're simply using it to pay for tuition. So you may see that from time to time. Okay, any questions? Let's see, do we run through this? Let's run through the rest of it. Okay, we have the data for the college. And then down here it says, did the student receive a 1098-T, which they typically will. He's in the first year, so he didn't receive one for 2019. That's the EIN for the college. And then no, he did not claim the American Opportunity Credit or the Hope Credit. That's the old name for it, for 4 years. And he was enrolled at least half-time, established by the university or the college. And he didn't complete 4 years of college before this tax year. And he didn't have a felony conviction for possession or distribution of a controlled substance. That means drugs. And so remember one time I was working with a criminal investigator and I said, hey, where do you find the list of all these things that the federal government considered controlled substances? So we went to the DEA website, the Department of Drug Enforcement Administration, and we saw the laundry list of all the drugs. And I think you need to be a pharmacist to figure out that stuff. But anyway, that's that. Of course, if someone's convicted, they're going to know they've been convicted. If they say yes, they were convicted, they're not eligible for the credit. So, okay, any questions before we leave this screen? This is our 1098 screen for college.
Yeah, Jerry, so, what if the person doesn't remember if they've claimed the Hope credit for 4 years?
You know what you could do, and this might be a couple of steps and maybe a little bit of an obstacle, but you can reach out to the IRS. You can get transcripts, and there's different types of transcripts, and you can say, like for example, they can go back not just 1 year, but a number of years, and that might be one way to do it. And I understand maybe they went to college 5, 6 years ago, but that information would be in that big iris computer in the sky, and they could reach out to the IRS and get that assistance. And, you know, contrary to a popular belief, I got it when you call the IRS, sometimes you're on hold for a while. But when you get that representative, they're usually very good. They'll help you out. Sometimes they'll respond. They'll do some research and respond the next day or a couple of days later. But when I call the IRS as a taxpayer, and they know I'm a former employee, but, you know, they treat me just like anybody else. They do a good job. So hopefully that helps you out. Anything else?
Yeah, Jerry, if the scholarship is not restricted to being used only for tuition and fees, Publication 970 talks about taking the scholarship as taxable income and then claiming the entire expenses as qualified expenses. Do you want to talk about that?
Yeah, you can do that. That's another way to do it. Some sites, what they'll do is an individual will receive a scholarship and they'll say, you know something, I'm going to go ahead and claim this as a taxable event. And when they do, then all of the expenses, in this case, that $4,500 can be used to calculate the credit. Yeah, you can do that. And you are absolutely right. That publication 970 has a number of examples. And so I would encourage you to take a look at this. There's also a U.S. Treasury publication that has some great examples. And one thing that frustrates me about that U.S. Treasury publication, it is undated. I think it came out about maybe 4 or 5 years ago. But that's still guidance, if you will, when you want to claim your scholarship as a taxable event. But yeah, you're right. Get to the publication 970. You can see some examples. Okay, any more questions before we move on? Okay, moving on. So we've entered all the data, and then now I think the last thing we're going to do, we're going to go to health insurance. And in this example, dad had insurance, and so they're not in the marketplace. What we will do when we come back in a couple of weeks, I'm going to have a couple of more returns, and one of those returns will have a covered California scenario where we're going to be looking at information from the Form 1095A as an alpha. Okay, and again, no state returns for the 2020 as of yet. And then we're going to go to e-file so I can show you the tax return in the Zoom call here. Okay, so we got a paper return. And then let's take a look at the return. Okay, and let's see. Mel, are you still with us? Can you see the tax return?
No, we're still in. Oh, no, we're still in the first tax layer.
No, not yet.
Can't see it
Jerry,
yet.
if you go to the search return and then approach it from that side to print it, I think you can.
Okay, so I'll stop sharing and let's see if we can show you this. And it might take a minute or two. Okay, so was that Steve that was talking?
That's Mel.
So Mel, so walk me through to the search thing. What do I do now?
So get out of the return and
you have the same problem. Your issue was a Zoom issue of not switching to the other screen.
Okay, so can one guy take me to where I need to go to display it on the computer?
You can exit the return.
Okay, so we'll go with you then. We'll go with you. Hold on a second. Let me log out and walk me through, and let's see if we can show it.
I was able to print it, Jerry, on, if you go to the search, when you go to practice lab, go into the,
okay, I'm in the practice lab now, so I'm gonna go to practice area.
Yeah. And then go to the client search.
Okay.
And then from there, you can print Harris.
And we go to Harris. Now I want to display it, not print it.
Yeah, tag it on the PDF.
Okay. All right. So what's my next step?
No, he wanted you to go, he didn't want you to enter the return. He wanted you to print from
Print it from the search. Yeah, you enter the return, sorry.
All right, stand by.
See that print icon? Hit that thing.
Okay.
Don't hit the select.
I do not see a print icon. I hit select.
To the left a little bit.
There's a printer on the left of the select.
Okay, let's go back.
That one I can see. If you go, that's the return already.
Okay.
Depends on, that's the 1040 already.
Tools, dash.
To the left of tools, to the left
of tools.
To the left of tools.
To the printer icon.
Yeah, right there. That's
Yeah,
it.
printer
No,
icon.
no, that one. Yes.
Gotcha.
Yeah, you got
no,
it.
you missed it.
Gotcha. Create the return?
No.
Just look at it.
This print.
Okay, I'm going to go real slow. Talk to me.
Click the down arrow by the printer. Select one of them down there. Paper file copy, that's good.
Gotcha. Okay, I gotcha. Okay, so let's see if this displays.
Well, no, it's in a new window. Just like before, you have to go back in Zoom and open a new screen share.
All right, stand by. Yeah, I'm not seeing it here. Not seeing it. Okay, well, I think there's another way to do it if I'm not mistaken. So hold on. Let's look at this. Can you see anything now?
Yes.
Yes.
Okay. All right, so let's take a look. What's that? Okay, so let's take a look at the return here. Okay, so we've got the filing status, married filing joint, we've got the administrative data. We've got the 2 kids. And yes, we've got the child tax credit for Fiona. Ernest doesn't qualify, or they don't qualify for Ernest because he's over 17, he's not disabled. We got the wage income, and we've got the interest and dividends, and then we've got that prize of $150. So total income is $33,168. And then we have our standard deduction, and that standard deduction of $24,800. That's the 2020 amount, so we're good there. And then we have our taxable income of $8,368. All right, and then we go over here to page 2, and you can see the tax is $838, and then we've got 2 credits that offset the tax. And those credits are non-refundable, so it's a dollar for dollar reduction of the tax. And so in this example, the taxpayer has 0 total tax. And you might see a situation not in VITA because if you use the TaxSlayer Pro software, it'll only generate a 0 amount on line 24. But sometimes you're going to have negative taxable income with other software programs. But in this one, it just shows you 0. Okay, and then we've got our withholding from the W-2 of $3,500, and then you can see because these taxpayers are low or moderate income, you can see they receive the EITC, the additional child tax credit, and the refundable portion, which is 40% of the American Opportunity Credit. So all of that totals $10,015, and then they have no tax liability because on line 24 it's 0, and so that means that's their refund, $10,015. And I think I mentioned this before, last week, the week before. You may see individuals who are low income who walk out with a refund that's over $10,000. That's quite possible. So let's go to the adjustment page, Schedule 1. We see the cash prize is listed there. And also on line 8, you'll have your lottery winnings, you'll have your jury duty pay, your items like that. And then on page 3 or Schedule 3, you're going to have your non-refundable credits. Your child and dependent care expense credit is $675, and then the education credit, again, non-refundable, simply a dollar for dollar reduction of the tax. And let's see, we don't have itemized deductions, and I'm not sure what the site coordinator is going to give you guidance on, but what I do is when we print out stuff for taxpayers at the VITA site, I will give them the Schedule A and I will explain to them they've taken the standard deduction, the software simply generates this. For my paying clients, I remove this document from the package that I give them, unless they itemize. Here's interest and dividend. Here's your 2441. At a minimum, you probably want to just explain the very basics to your taxpayer, confirming there's their child and they've paid for the child. and then you can see how the credit is actually calculated. And you can see in the chart where it says if line 7 is over but not over the decimal amount, you can see that your high income taxpayers who pay for someone to watch their child, they can get this particular credit. And again, this is, I think, one of the only few credits you can be making lots of money as a wage earner and still get it. It's not phased out, because a lot of things are phased out. Okay. And then your earned income credit. It's nice to go through this, at least for yourself, so you can familiarize yourself at the VITA site. But going through this form with your taxpayer, it would probably be very time consuming, very time consuming. Here's your additional child tax credit. You can see how that's calculated. When I am with the taxpayer, they may look at the form. I don't usually go through this form with them. Again, it's going to be very time consuming. Now, for this particular document, I will spend a little bit of time with the taxpayer, the education credits, and I'll explain to them there's 2 different credits, and typically most people want that American Opportunity Credit. So if they qualify, we'll show them that, how it's calculated. And a lot of people say, well, Jerry, I paid $9,000 in tuition. And I'll say, that's true, but the credit will take that amount, excuse me, the calculation will be, let me restate that. The form will take that tuition that you paid and calculate the amount of credit. And they'll go, okay, I got it. So my tuition that I pay is not the credit. That's correct, it's not. And then you can walk through the lines here with them. Okay. And then here's the second page of the education benefit. And we've already talked about that. And I think that takes care of it. All right. So what I'm going to do now, I'm going to stop talking. And if you have any questions or if you have some comments, and we've got some great comments today, especially the one, and I forget who it is, mentioned about the sales tax. So in that scenario that we did for the Tomas Silva one, if you go back and you enter data for the sales tax calculation, it'll populate on the Schedule A. So that was a very good point. Okay, so I'm gonna stop talking. And what do you want to know, or what comments can you offer?
I have a question.
Sure.
This is Yvonne. Didn't you mention to us last time that if you didn't receive a stimulus check, there was some kind of a credit?
Yeah, there's a rebate credit, and we're going to talk about that rebate credit. I think it's on our last session. Or no, next session, we're going to talk about finishing the return, so we can talk about the rebate credit in 2 weeks.
Unfortunately, I won't be available. Okay.
You can watch the Zoom presentation.
Oh, perfect. Okay, thank you.
Okay. I should say the recorded Zoom presentation. Anybody else?
Bill DeLuca, how do you get to the Zoom presentation?
That would be contacting the VITA leadership team at St. Killian's, probably Steve or Fred.
Okay, thank you.
Yes, that is Fred sent that every week. So after the session, we usually send it on a Tuesday or a Wednesday to everybody, just to make sure that they have a copy of it. So yeah.
Hey, Steve, a question for you. Are you able to hang the Zoom recordings on some website that the church has, or maybe the VITA ministry link?
Yeah, we can do that. The only thing we need to do is download the presentation, and then what I'm gonna do is I'm gonna edit it and make sure that it's shortened to the particular, I will have to remove, because it's gonna be a big file, and then I'm gonna coordinate to the website St. Killian Webmaster and say, hey, can we publish this? And yeah, it's doable. We haven't done that yet because we haven't had a chance to get in contact with them yet.
Okay, great, thanks.
Hey, Steve, check with me later. I have a program that'll compress your file about 10 to 1.
Oh, that's great. Yeah, that's great. What I'm gonna do is I'm gonna. This is Scott. Is that Scott?
It is.
Yeah. Oh, Scott. So what I'm gonna do is I'm gonna download the presentation, and what I'm gonna do is I'm gonna share it to my OneDrive, and then you can just grab it and see if you can shrink it for me.
Okay.
Yeah. So I'll coordinate with you offline on that one. Thank you.
All right. All right. Good deal.
Jerry, I have a question. This is Anna Abrams.
Yes.
I think you mentioned that you're teaching a class at, I believe, the Orange Coast College. Do we register through the Orange Coast College, or how do we register for that?
The class that I teach is at Coastline College, and it's called the VITA 1 class, and that starts in early January. It goes for about 3.5 weeks. And what the VITA 1 class does is it takes the students through essentially the basic certification, the advanced certification, and the military certification. And then we have Zoom presentations, we have assignments. Of course, that includes preparation of tax returns. And so all you do is just go on the Coastline College website. And if I'm not mistaken, I think there's no materials that you got to buy. We use the 4012 and we use the 6744, but you do have to pay, I think it's a 1 credit class. So you got to pay like $46 or $48 for the college class.
Okay, thank you.
Sure. All right, anybody else? And then I'll mention this before we get off the call here. In 2 weeks, because next week we're not going to have our session, but the next 2 weeks, what we'll do is we're going to discuss finishing the return. In fact, let me do this. Let me bring up my my PowerPoint here so I can go ahead and show the group here what we're going to do in 2 weeks.
Gary, I'm sorry, could you repeat? Is there no class next Saturday?
Correct. According to the schedule I have, the next class is going to be on the 5th of December. And so what we'll do on
Thanksgiving week, okay.
Yeah, what we'll do on the 5th of December, we'll talk about other taxes. I'll try to address the question regarding the deferral of self-employment tax. We'll try to give an example of sales tax on that one also. We'll talk about the earned income tax credit and payments, and we'll talk about finishing the return, and then I think those are the topics. Those are probably the topics. And of course, the ACA example that I'll give you, we'll go through that.
This is Julie. I just wanted to say that last week they gave us a link to the United Way VITA, and you can go on there and you know, after you do your test, you can actually click on a thing that you take the test there, and it tells you whether you got the answers right or not. And if you didn't, it tells you where to look. It doesn't tell you what the answer is, but it was really helpful.
Oh, that's very good. Is that something that has been pushed out by the St. Killian's VITA team?
Last week it was on, I think it was on one of the PowerPoints, but then they also put in the chats the link. It's let me just go real quick here, and I can tell you, it's called, it's a study guide, but put out by VITA through the United Way. It's vitasources.net/studyguides.html. We got it last week.
Okay. Hey, Julie, do you mind putting that on the chat, that
Sure.
address, that way everybody can see it?
Sure.
I don't think so. Yeah, thank you.
That sounds like a really good tool. And if I understood you correctly, that means you take your certification and then you use that tool to essentially learn what you got right and what you got wrong.
Yes, and if you go on the website, I'll send you the link. There's a spot, it's real tiny, but it's, if you kind of scroll down, it'll say Study Guide for Advanced Tax Test 2020. You can read through that. And then a bit further down, there's a link to Advanced Certification 2020. And the woman who has set this up, you basically take the test, and then it comes back with whether you got the answers correct or not. And if you didn't get it correct, it tells you where to kind of look for it. And she does give a little disclaimer that this is basically her understanding until the test is actually done. But it's wonderful. I mean, it was so helpful. So I'll everybody the link.
That's good to hear. Okay, great. Yeah, and then also during this session on the 5th, we're going to go through a couple returns, and I will send those returns out to the leadership team so they can get it out to anybody who wants it. And those scenarios will be similar to the scenarios that we saw today, but of course we'll have other things like Affordable Care Act, we'll have the Earned Income Tax Credit, and we'll also talk about that rebate recovery credit that we discussed. All right, well, so that's all I have then. Any other questions before we go?
Yeah, Jerry, this is Sean. I had one question. We talked about American Opportunity Credits and lifetime learning credits, but we did not talk about tuition and fee deductions.
No, we didn't talk about that today. We talked about that, I believe that was last week.
Okay.
And with that, the tuition and fees deduction, it's something that you can use, but typically getting bang for the buck would be the American Opportunity Credit, or the other credit that's a dollar for dollar reduction of the tax as opposed to reducing the amount of taxable income. But yes, that is still one of the benefits.
Hey, Jerry.
Yeah.
Next time when you send the PowerPoint, give me a 1-day heads up, because I think today's came in early in the morning and I pass it to almost everybody else. I knew I missed somebody by name, so just bear with me that those who haven't got those PPP for today, just email me if they want to get a copy.
Yeah, and I got plenty of time, so the next PowerPoint will go out probably about 2-3 days in advance. So yeah, we'll get that out along with the practice returns, Fred.
Thank you.
Okay. All right.
To everybody else here.
Hey, Jerry, can you send it out before 2 or 3 days before the class so we can work on it?
Ooh, well, I would have to get at least one pretty please.
Pretty please.
Okay, I'll send it out. How about we'll send it out about a week before that December 5th gig.
Wonderful. Thank you.
Okay.
Thank you.
And Jerry, can I ask a quick question? This is Cecilia with Community Action Partnership at the Southwest Community Center. I just wanted to know, how do we get the all of your scenarios that you had?
I've sent out 2 so far. I mean, if you want, what I can do is I can make sure when I send out that blast next week that all the scenarios go with it. But typically I'll feed my information to the VITA team at St. Killian's and they'll push it out in a distribution.
I just want to make sure I have your name. If your name is not on my list, you don't get copy or email address.
Okay, I'll check. There's a couple of people from my team on the training, so I'll check with them to see if I can get your email. Thank you, Fred. Thank you, Jerry.
Okay.
See you again.
All right. Well, folks, I've got 11:56. How about one more question, then we'll call it quits. No more questions? All right.
Good class, Jerry. Thank you.
Okay. Hey, thanks everybody, and all the folks who threw out nuggets of information. I really appreciate it, especially that sales tax one. That was a good one. So we'll see you in 2 weeks, and you'll get the information regarding practice returns and the PowerPoint about a week out.
Thanks, Jerry.
Thanks,
Okay.
Jerry.
And
Thank you, Jerry.
Thank
you for recording this.
Happy Thanksgiving, everybody. Thank you.
Thank you, Jerry.
Thank you.
Be safe, everyone.
Thank you, Jerry.
All right, take care.
Thank you.
Fred, are you still there?
Yeah, still here.
We need to kind of discuss refine our approach on the season, supplies and procedures.
Let's get a Zoom together. Let's plan a Zoom sometimes.
Thank you.
Sometimes next week with Steve and the rest of the corner leader.
Yep.
Okay, folks. Jerry signing off.
Okay, thank you.
Thanks, Jerry.
Take care. Bye-bye.
Thanks,
Bye-bye.
Jerry.
Thank you, Jerry. Appreciate it. I'm back. Finally.
So Steve, are you still there?
Yeah, I'm here. I'm here. Hold on. Let me just.
It's still recording.
St. Killian, stand by.